SICC is a leading integrated financial service provider in Asia. Through our network of local offices in Malaysia, Indonesia, Singapore, Thailand, branches and strategic partners, we have a global presence in over 20 countries, providing a truly Asian perspective. Our businesses include retail broking, institutional equities, derivatives, prime services, equities research, wealth management, and online broking. We also offer a range of Islamic services, such as Islamic stockbroking window, Islamic cross-border trading, Islamic securities selling and buying negotiated transaction. Backed by an award-winning research team, we have one of the most comprehensive research coverage of over 800 stocks in the region. Our strong research capabilities form the backbone of our product and service offerings, connecting clients to opportunities. CGS CIMB, your financial gateway to Asia.
At Bursa Malaysia, we give you access to all kinds of doors, so you can profit from all kinds of opportunities. You'll find doors that lead to businesses as old as the land itself, doors that open to the future and the wealth of opportunities that await. Some doors open multiple pathways for you and for everyone else. And they are supported by the doors that unlock the energy that powers everyday life. There are doors to solutions that are good for people and the planet. And doors that hold new ideas, new ways of connecting data that can change everything we think we know. There are even doors that empower everyone through values that are fair, just, and transparent. While others bring the world to us to shape our brightest minds, you can open doors that take you across the world with just a click, or give you access to the economic roots of the ASEAN. We connect businesses and investors of all sizes. At Bursa Malaysia, businesses raise funds and gain visibility, while investors seize opportunities to grow their wealth. Trust and rely on us. Open the doors, step in, and create the impact you seek. Bursa Malaysia, creating opportunities, growing value.
CGS-CIMB is a leading integrated financial service provider in Asia. Through our network of local offices in Malaysia, Indonesia, Singapore, Thailand, branches and strategic partners, we have a global presence in over 20 countries, providing a truly Asian perspective. Our businesses include retail broking, institutional equities, derivatives, prime services, equities research, wealth management, and online broking. We also offer a range of Islamic services, such as Islamic stockbroking window, Islamic cross-border trading, Islamic securities selling and buying negotiated transaction. Backed by an award-winning research team, we have one of the most comprehensive research coverage of over 800 stocks in the region. Our strong research capabilities form the backbone of our product and service offerings, connecting clients to opportunities. CGS-CIMB, your financial gateway to Asia.
At Bursa Malaysia, we give you access to all kinds of doors, so you can profit from all kinds of opportunities. You'll find doors that lead to businesses as old as the land itself, doors that open to the future and the wealth of opportunities that await. Some doors open multiple pathways for you and for everyone else. And they are supported by the doors that unlock the energy that powers everyday life. There are doors to solutions that are good for people and the planet. And doors that hold new ideas, new ways of connecting data that can change everything we think we know. There are even doors that empower everyone through values that are fair, just, and transparent. While others bring the world to us to shape our brightest minds, you can open doors that take you across the world with just a click, or give you access to the economic roots of the ASEAN. We connect businesses and investors of all sizes. At Bursa Malaysia, businesses raise funds and gain visibility, while investors seize opportunities to grow their wealth. Trust and rely on us. Open the doors, step in, and create the impact you seek. Bursa Malaysia, creating opportunities, growing value.
Thank you, Chiming. Thank you very much. Assalamualaikum warahmatullahi wabarakatuh. Selamat sejahtera and a very warm welcome to all participants to Shariah Investing Corporate Conversation 2021 or SICC 21. Okay, while waiting for more participants to join us, I will be your host. And again, before we start, allow me to do some housekeeping first. We have put all participants on mute. Kindly keep yourself on mute throughout the session. If you have any questions for Ivy or the corporates, please type your question in the Q&A box. You can find this at the bottom of the screen. And you can do this throughout the event and we'll try and answer them all. The first half of the event will be streamed live on Facebook. Will be streamed live on Facebook. However, all corporate presentations will be closed session. So to all participants, we hope you can stay with us until the very end and listen to the corporates. Okay, on the screen now, you can see the program for today. We will have Ivy to present our Shariah strategy later, followed by 4 corporate presentations. As this is a live event, no editing and so on. So we hope everything will go as planned, inshallah. And of course, we would like to thank Bursa Malaysia, our media partner, IFN, and knowledge partner, Majalah Labo, for their support, and especially to our corporate presenters today, 4 of our top Shariah picks, MPI, Axis REITs, Top Glove, and LSK Group. A huge thank you from all of us. So now, without further ado, I would like to invite Puan Ruzi Rani, CEO of CGS CIMB Securities Cenderam Berhad, to give her welcome remark. Over to you, Ruzi. Okay, please start, Ruzi.
Okay. Thank you, Brother Rashdan, for the introduction. Bismillahirrahmanirrahim. Yes, financial markets are witnessing the growing success story of Islamic finance, a unique form of investment which corresponds with the value of socially responsible investing. It is a genuine social economic component that renders it equally attractive to investors of all faiths. Investment and Islamic investment products share a common ground, and the recent surge in demand for ethical products could provide an uplift for Sharia investments too. Assalamualaikum warahmatullahi wabarakatuh. Yang berbahagia Datuk Muhammad Omar Sharif, Chief Executive Officer Bursa Malaysia, distinguished guests, and a warm welcome to all. Thank you again, Bursa, for providing us the opportunity to jointly organize the Sharia Investing Corporate Conversation 2021. For CGS CIMB, it is an honor to have this platform to share with everyone our journey and aspiration in championing Islamic products and services in Malaysia. Our aspiration is to become the regional leader in Islamic broking space within the next 5 years. We are very much committed to see this through despite the challenges. We want to offer not only a fully Sharia compliant stockbroking services, but also innovative Islamic products as well. Islamic margin financing, ISSBNT, and Islamic futures are in our pipeline to be launched soon. We aim to provide a full-fledged Islamic finance services for Sharia and socially responsible investors for them to relish the same experience as any other investors in the market. Last June, at the inaugural Sharia Investing Conference, CGS CIMB had successfully launched our Islamic cross-border trading for our Sharia investors. We offer a borderless and a complete Islamic ecosystem, including Sharia stock selection process. We are currently the only broker that offers this feature online in the market. I'm also proud to announce that we are the first brokerage house to introduce our Islamic securities selling and buying negotiated transaction, or ISSBNT, following the approval from Securities Commission on our framework recently. And inshallah, by end of first quarter 2021, our Islamic share margin financing will be offered to all investors as well. Ladies and gentlemen, moving forward, we wish to collaborate more with Bursa to look into more initiatives on expanding our Islamic broking horizon. We are looking into creating the first ESG ETF and Waqaf products in Malaysia. And today, we are delighted to introduce yet another collaboration between Bursa Malaysia and CGS CIMB. The launch of the first Sharia research reports scheme, where CGS CIMB will provide 2 Sharia strategy reports per year. You will get to hear more on this later when our Head of Research, Ivy Ng, presents the report. You will also hear firsthand from 3 of our top Shariah picks, MPI, Access Rate, and Top Glove. These are just some of the many initiatives to come, and God willing, with our sincere efforts and prayers, one day our vision of a vibrant Islamic market and ecosystem will be realized. I hope today's session will enable participants to have a glimpse of our Islamic efforts and be able to familiarize yourself with the available tools and platforms to navigate the Malaysian market better in accordance with the Shariah principles. With this, I wish everyone a successful and a fruitful 2021. Terima kasih. Wabillahi taufiq wa hidayah. Wassalamualaikum warahmatullahi wabarakatuh.
Thank you, Rosie. Thank you so much for delivering the welcome remarks. So now, without further ado, I would like to invite Datuk Muhammad Omar Swift, CEO, Bursa Malaysia, to deliver the keynote address. Dipersilakan, Datuk.
Thank you, Rashda. Thank you, Rosie. Good afternoon. I'd like to extend a very warm welcome to all our speakers and participants at the inaugural Shariah Investing Corporate Conversation, or SICC 2021. Let me begin by thanking our partners, co-organizer and one of the exchange-registered Islamic POs, CGS CIMB Securities, media partners, Red Money Group, and Majalah Lampu. It is rather unfortunate that we're unable to host you physically. Nevertheless, despite the current global health pandemic, continuity is essential. The COVID-19 crisis has accelerated the trend for a more sustainable approach to investing. I'm confident that SICC 2021 can be an effective platform to support this approach from a Shariah perspective during this unprecedented and challenging times. Ladies and gentlemen, 2020 will go down in history as a very challenging year. However, despite the global pandemic, Malaysian equities have demonstrated resilience and were among the best performing ASEAN markets. Following the sharp fall of the FBM KLCI in the first half of 2020, the index recovered to close the year 2.4% higher, with the total return in 2020 was 5.8%. The strong domestic liquidity continued to support the market and the funding needs of companies listed on the exchange. Foreign shareholdings remained at a healthy level of some 20%. In ASEAN, the Malaysian equity market registered the highest gain in average daily value, or ADV, reflecting the confidence and sentiments of investors in our market. The re-emergence of the retail investor in our market had a positive impact on improving liquidity and depth. In 2020, retail ADV increased 230% to 1.6 billion ringgit, the highest level recorded in Bursa Malaysia's history. More significantly, 65% of total CDS accounts were opened by millennials. The increase in millennial investors is a positive development for the long-term sustainability of our market, as they are the key drivers of socially responsible investing. Ladies and gentlemen, in a post-COVID era, where change and uncertainty seem to be the only constant, an increasing number of investors are taking on an approach towards responsible investments. Similarly, COVID has also brought into sharp focus on sustainability and business resilience. The realization that the strategic approach of integrating sustainability and transparency into business operations has given these PLCs more agility in responding to unexpected events. There is much potential and opportunity to grow Shariah investing due to the profound similarities of Shariah investing and socially responsible investing. They both focus on encouraging more ethical, responsible, and transparent practices. This global shift augurs well for Malaysia and our marketplace. Having successfully established our leadership as the global marketplace for Shariah listing and investments, amongst our accolades, Bursa Malaysia has been named the best stock exchange for Islamic listing by Islamic Finance News in 2018 and 2019. Supported by some 16 Islamic brokers, Bursa Malaysia I, the exchange's end-to-end Shariah-compliant investing platform offers both faith and ethically based investors access to broad spectrum of opportunities listed on our marketplace. Allow me to share some key statistics and value propositions with you. As of December 2020, 742 out of 936 listed entities, or 79% of listed entities, are Shariah compliant. Shariah market capitalization stood at Ringgit Malaysia 1.3 trillion and makes up some 69% of total market cap. The ADV of Shariah compliant securities was 77% of the overall ADV of 4.2 billion ringgit. Over 2/3, or 71% of the PLCs on the FTSE for Good Bursa Malaysia Index are both ESG and Shariah compliant. This index measures the performance of Malaysia's PLCs, demonstrating strong ESG practices. Additionally, Bursa Malaysia's Shariah indices have constantly outperformed their conventional counterparts over the last 10 years. For example, the FTSE Bursa Malaysia Hijrah Shariah Index, comprising the 30 largest Shariah-compliant companies on the FTSE Bursa Malaysia EMAS Index, have consistently outperformed FBM KLCI, growing about 30.8% between 2010 and 2020. The Malaysia Islamic capital market has much to offer, and these are just some of the indications of the value that Shariah-compliant investments can provide. Ladies and gentlemen, in conjunction with today's conference, we are excited to launch the Shariah Research Report Scheme 2021. The Shariah Research Report Scheme aims to bring a multitude of benefits, generating investors' interest in Malaysia Shariah-compliant equities market and increasing the visibility, transparency, and investability of Malaysian Shariah PLCs. Its content will reflect up-to-date and relevant information, which would include in-depth analysis and performance of Malaysia Shariah-compliant equity market, key thematic plays and stock picks, and investment strategies. While research reports on PLCs are commonly available, there are few and far that focus solely on Shariah PLCs. The exchange aims to address this gap and is committed to facilitating better value recognition and growth of Malaysia's Shariah-compliant equity market. Ladies and gentlemen, as we transition into the new normal, Islamic finance's role as providers of responsible capital needs to be harnessed to contribute to the overall sustainability agenda. Special thanks to our participating Shariah-compliant PLCs for today's conversations. They are Malaysia Pacific Industries Berhad, Access Real Estate Investment Trust, Top Glove Corporation Berhad, and LSK Group Berhad. We have been engaging with our Shariah-compliant PLCs, many of whom appreciate the prospect of receiving research coverage. Their role in ensuring the scheme's success is particularly important, especially in opening doors for investors to gain better value recognition for your company. And on that note, I wish everyone a productive and impactful day ahead. Thank you so much. Over to you, Rashdan.
Thank you. We would like to play a short video now. Excellent. Okay, thank you very much. Thank you, Dato', for that wonderful keynote address and for officially launching today's event. Now, let's hear it from Ivy Ng, Head of Research, CGS CIMB Securities in Berhad, on key takeaways from our Shariah strategy report. So over to you, Ivy.
Hi, afternoon. Rashtan, can you see my screen?
Yes. Probably you can make it presentation mode.
Yeah, okay, let me try.
Yep.
Right, okay.
Okay, better, thanks.
Right, okay, good afternoon, everyone. And firstly, I would just like to thank Rashtan for the kind introduction. So I'll take you through our Shariah research report. This is an inaugural report from a strategy perspective that we take a look at the equity market purely from the lenses of a Shariah investor. So what we have done in this particular report is basically to strip out all the non-Shariah compliant stocks from our analysis in coming up with the strategy outlook for 2021 for the Malaysian stock market. So before I start to go through the content of this presentation, I thought I'll start off by giving a brief summary of how what is our view on 2021 in terms of market outlook. So our view is that 2021 will be a much better year for the equity market. And if we really have to choose between first half and second half, we are predicting that perhaps market will do better in the first half versus the second half. And what is really driving the market in our view, there are four key things that we think will be driving the market for 2021. First is it'll be driven by corporate earnings. We are predicting that KLCI earnings will grow by about 37% in 2021, and that will represent one of the highest earnings growth for corporate Malaysia for many, many years. And I'll take you through the reason behind this strong corporate earnings. Number two, we think that the market will also be driven by liquidity available to retail investors, partly coming from the low interest rate environment. And we'll share with you, how dynamic is the retail investors in our stock market today in our research report. Thirdly, we talk about sentiment. So in order for market to do well, the outlook, the sentiment for the market must be positive. And we think compared to a year ago, now with the availability of vaccine, sentiment will be much better going into the later part of this year. But given that investors tend to be forward-looking, so we think that market will do well on the back of the improved sentiment. The moment we get the vaccination program going, we suspect that investors will become more confident on corporate earnings and will probably start investing back into the stock market. The last point is on the return of the foreign fund flows. For us, this will be a bonus if it happens. Going into 2021, we think that emerging market could do better, basically because there's a lot of liquidity in the market and they're looking for higher return for their funds. Emerging market may be one of the market that investors will be looking to get into to get a better return, and Malaysia being part of the emerging market, we think could potentially benefit from this fund flowing back to emerging markets. So those will be the four key reasons that we will be tracking quite closely as to why we think the market will do better in 2021. Now, the key concern, perhaps, if we want to talk a little bit into going into second half of the year, is there is a concern that corporate earnings growth may peak in second quarter. So if that is the case, then perhaps the positive news flow from corporate earnings could be waning as we go into the later part of the year. So we will take a closer look into that come second quarter of this year to see how sustainable is the corporate earnings. We also were slightly worried about whether the stimulus measure were ending and whether the kind of liquidity that we are seeing can be sustained going into second half. So again, something that we have to take a closer look and review as we enter the second quarter of the year. And lastly, is about the snap general election that could be called, once we are able to contain COVID-19, as alluded by, our Prime Minister in his recent speech. So something that we have to watch out closely because all this event could potentially impact sentiment for the market and derail the kind of trend that we are looking at this juncture. So in this report, we will share with you some of the trading themes that we have thought out for 2021 and sector picks that we like in the Shariah space are the tech, the EMS, the glove, the oil and gas, and the healthcare. And in terms of the top three Shariah stock pick, among all the Shariah stock pick that we have, we would propose Inari, Top Glove, and Telecom. So this is actually the content of the research report. You can actually get a copy of this research report through Bursa Malaysia website or through CGS-CIMB iTrade platform, I think at the end of today. So let me start off by giving you a bit of background on Islamic capital market. There are two parts to the Islamic capital market. You have the equity and the sukuk market. So for this presentation today, we will be focusing on the equity portion of the Islamic capital market. And as I mentioned earlier, we will only be considering Sharia compliant securities. So for those who are interested to know how a company can become Sharia compliant, basically they need to go through a screening, a Sharia screening exercise. This is done by the Sharia Advisory Council of Security Commission. You will find a list of Sharia compliant securities on a biannual basis in Security Commission website in the month of May and the month of November. And basically, to be Sharia compliant, you have to meet business activity benchmark, financial ratio benchmark from a qualitative perspective, but there could be from a quantitative perspective, and there's also some consideration on the qualitative aspect of it. So I'll leave you to read the details on this. And for example, if let's say a stock's originally Sharia compliance and subsequently they've been classified as non-Sharia compliance, there are also guidelines for investors. But in short, there could be some selling activities if a stock is deemed non-Sharia compliance from Sharia compliance perspective, from previously from being Sharia compliance, because the advice is that for investors to sell the stock if it is in the money. Okay, so there is some consequence if a stock is classified as non-compliant. Now the good news is that in the Bursa Malaysia, there are a lot of stocks that are Sharia compliant. So if you take a look at 2020, about 79% of the stocks listed on the stock exchange are Sharia compliant. So you do have a wide variety of companies to choose from if you are investing from a Sharia perspective. Now, in terms of sectors that have the most Sharia compliant stocks, I would say if you take a look at this chart, it will show you that it's the technology sector, the construction sector, and the healthcare sectors where you have majority of the stocks in that particular sector that are Sharia compliance. But if you want to look at it from a number of stocks within the sectors, then it will be industrial, consumer, and property, with the most number of stocks from a sectoral perspective that are Sharia compliance. We have seen also an increasing interest in Sharia investing. You can clearly see from the percentage of Islamic asset under management out of the total asset under management. It has grown from 22% in 2017 to around 24% in December 2020. So it's an investing strategy that is gaining momentum over the years. So in terms of how do we track the Sharia performances, so there are actually 4 indices that focus on Sharia stocks. You have the FBM Hijrah, FBM Emas Sharia, FBM Small Cap Sharia, as well as FBM Mid Sharia. But for this report, we will focus on FBM Hijrah, which represents the top 30 largest market cap stocks that meet the Sharia criteria. Okay, so if you take a look at the performance of, say, a conventional indices versus Hijrah, and here we are comparing KLCI against the Hijrah index. KLCI mainly represents the top 30 stock in Bursa Malaysia, the top 30 largest company on Bursa Malaysia that meets the eligibility criteria of FTSE Bursa Malaysia. What you can find is that the Hijrah Sharia index has outperformed the conventional KLCI in 7 out of the last 10 years. And the key differences, I would say, between KLCI and Sharia lies in the banking sector. So KLCI index heavyweight on the banks. They account for about 32% of KLCI total weightage. So at times when you look at the performance of KLCI against Hijrah, if you do find the banking sector outperforming, then chances are KLCI could outperform the Hijrah Sharia. So the key difference between the two, the main key difference between the two lies in the banking sectors. Now for Hijrah Sharia Index to do well, typically you would have the healthcare, F&B, telcos outperforming, because these three sectors are the largest, have the largest weightage in the Hijrah Sharia Index. Okay, so what we want to show here in this chart is if you start looking at, say, the COVID-19 period, you will find that, you know, the Hijrah Sharia Index outperformed the KLCI during COVID times. This is mainly due to the outperformance of the healthcare and in particular the glove makers. And this chart shows you the history of the outperformance of Hijrah Sharia against KLCI. And this basically stripped down further the component of the stocks as well as the sector that make up KLCI versus Hijrah Sharia Index. And here you can see that KLCI is dominated by the banks, but under Hijrah Sharia is dominated by glove and utility, in this case, Tenaga Nasional. And the key difference, of course, in KLCI, you have the banks making up 32%. You don't see the banks in the Hijrah Sharia Index. So this one basically just to share with you historical performance of the indexes and how the various sectors have performed. What we want to point out here is that technology and healthcare sector were the top performing sector during the COVID period, and going into January 2021, tech continued to outperform the rest of the sectoral indices. Also, Malaysia has outperformed the regional indices in 2020, and this is due to largely to the glove makers. If we were to exclude the glove makers' strong performance in 2020, we estimate that KLCI potentially may have declined about 5.8% in 2020. Now, this page actually tried to analyze the key difference between Sharia and non-Sharia compliant stocks performance in the KLCI. And what we want to share is that in 2020, you will find that the non-Sharia compliance company were harder hit by COVID-19. They are generally the banks and Genting Group, which are exposed to the tourism sectors. And in 2020, the Sharia compliance stocks did much better because the glove benefit from higher usage of glove and higher ASP, as well as the tech from the adoption of IT. Now, before we go into greater details on the outlook, I just want to share that since the vaccine news came into the picture, the Malaysian stock market have jumped in the last 2 months of the 2020 by about 11% because investors are very optimistic about the prospect of the economy return to pre-COVID level due to availability of the vaccine. So this is driven by sentiment. But when we start to have high number of COVID cases in January, we saw that, and with the MCO kicking in on the early part of January, what we saw is profit taking in the marketplace. So I think going into the rest of the first half of the year, the key important things to track in our view would be the vaccine news. Now, this is being rolled out around the world. We think a successful deployment of the vaccine will boost market sentiment and boost the performance of the market. So this chart basically shows you, first, how the countries are getting their vaccine in terms of commitment, and then the next thing is how are they going to do the vaccination program. So for Malaysia, the government has announced they have procured several vaccines. They're all in this chart. The good news is that the first batch of the Pfizer vaccine should be coming into Malaysia on the 26th of February. And following that, we are looking to start the vaccination, the mass vaccination program, which will be the largest ever held by Malaysia. And these are the different phases of the vaccination program that our Prime Minister has recently announced. So phase 1 will be up to April, will cover the frontliners. After that, we will cover the senior citizens and the vulnerables. And then the rest of the citizens will be getting their vaccine from May to February 2022. So hopefully by first quarter of 2022, if we are able to vaccine up to 70% of the population, we should be getting a herd immunity, which means potentially we could see the reopening of Malaysia's international borders coming maybe second half of the year. We think that this will be another news flow that could drive market performance. So I will watch out on the vaccination news, the border reopening news. We will also be tracking closely the earnings growth projection by our team as well as the market, looking at 38% earnings growth. I just want to highlight that this is not driven purely by the recovery from COVID-19 closure that we saw in March, April last year, but you are seeing exceptional earnings from the glove makers. Just to highlight, pre-COVID in 2019, if we were to aggregate the 4 glove makers, they're probably making only about 2 billion net profit. But come 2021, our analysts are expecting glove makers on a combined basis, the 4 largest glove makers in Malaysia, to make broadly around 16 billion. So that shows how significant the earnings growth of the glove makers contributing to corporate Malaysia earnings. On top of that, tech sectors are heading into record earnings as well. And we have seen CPO price at very high level that we've not seen for many, many years, as alluded in this page. And if ringgit strengthened, we could potentially see interest from foreign investors. And if we are able to reverse the outflow of foreign funds trend in Malaysia, that could be another booster for our Malaysian stock market. Now, the last point is with regards to some form of uncertainty heading into second half of the year is, of course, the good news is if we are able to contain COVID-19, then there's a possibility that GE15 could be called, as alluded in some of the statements made by the Prime Minister, and that could lead to some short-term uncertainty in the market. So something that perhaps we should track the news very closely with regards to whether a GE15 will or will not be called anytime this year. The fund flow I just want to share with you is obviously we have seen a lot of retail interest in the stock market. Just to highlight some of the key statistics, these are the number of new individual CDS accounts that was opened in 2020. You can see that the jump was significant at 132%. The bulk of the CDS account were opened in second half of the year. Also, the share of retail trade have jumped from, say, March during the COVID period of 26% of total trade to as high as 44% in August. Now, although the share of retail trades may have come down a bit in January, this is due to the fact that foreign investors have more trading activities because they did, I think, some short selling in January. And also they've been, trading more in January. So that is partly contributing to the lower retail share of trade in January 2021. But what we can say is that retail investors remain positive of the market. Their net buy in 2020 was 14.2 billion and remain positive in January 2021. Also important to note the net buying position of retail investors have outperformed those of local institutions for the first time in several years because local institutions only had a net buy position of 8.2 billion in 2020. And in January 2021, local retail investors remained the largest buyer compared to the other group of investors. Now, I just want to share with you the 8 trading themes that we have put out for the market for this year. The first one is laggard play. And how we define laggard plays is we look at stocks that are still trading below 31st December 2019 share price level. We consider this as laggard stock because many stocks, some of them have exceeded their pre-COVID share price level because of the relatively strong market performance last year. So we want to see, are there any laggards that could be in play for 2021? So we set out several screening criteria under this thematic. We say that firstly, the stock must be under coverage, they must be Shariah compliance, share price must be trading at least 20% below pre-COVID levels, defined as 31st December 2019 closing price, and we must like the stock fundamentally, not purely from a laggard perspective, but at least would have liked the stock even if it's not a laggard play. So you will find the list of stocks here. Generally, you'll find the property, the construction, the auto coming into this list. But I would say in terms of big cap, we have Tenaga, MIC, as well as IGM Corp, as well as DRB Highcom, forming this laggard playlist that investors can consider investing in if they like this trading team. Second trading team talks about beneficiary of foreign fund flows. What we are thinking is that if foreign funds do return to Malaysia, perhaps the first thing they may look at is some of the stocks that they may have invested in the past. They like the company, but maybe due to other reasons like political instability, they've sold the stock. So they may want to return some of the stocks that they like in the past. And so what we did was we screened for stocks where the foreign shareholding level have dropped between December 2017 and June 2020. Now we take December 2017 as a starting point because this was before GE14. So there was no, no concern of political instability before GE14. So that was a starting point and up to June 2020. So those stocks that have seen a big fall in foreign shareholding could see potentially foreign investors returning to Malaysia if they are looking to invest in Malaysia for currency reasons or otherwise. And topping the list is Inari, one of our top pick, which have seen quite a big foreign shareholding drop. So for the rest of the name, you can scroll through this list for beneficiary of foreign fund flow. This is actually looking at stocks which have seen an increase in foreign fund flow for the same period that we talk about, and you will see that generally the glove makers have been benefiting from increase in foreign shareholding level. Growth stocks talk about stocks that actually have exhibit strong earnings growth even beyond COVID. So we're not looking at a recovery because last year there was a shutdown and so forth, but more of organic growth. So we screen for stocks which have shown strong earnings in 2022 versus 19, which was the pre-COVID year. And you will see that topping this list of growth stocks would be your glove makers, your EMS sector, and your tech players. So these are the list of stocks we would recommend if you're looking for growth stocks, looking at earnings growth beyond COVID-19. Now, the next theme is on retail pick. So generally, we take a view that perhaps for some of the retail investors, they may say they wanted a smaller cap kind of pick. So we have looked at stocks with market cap of less than 2 billion. And we're looking at it from the angle of attractiveness on a PE basis. We're screening for stocks that are below 13 times PE, and you can see these are the list of stocks. And in terms of those stocks with highest upside in our small cap pick, you will have Lee Swee Kiat, which will be presenting today, Ma Sing, as well as Tong Guan. GLC picks generally look at government-linked companies that are expected to do strong net profit growth as well, coming from perhaps efforts by management to contain costs, or the industry they're in are doing well. So we screen for the same growth stock criteria, but in this particular case, we look at just the government-linked company within the growth stocks, and they must be Shariah compliance as well. So topping the list here, you will have Telecom, showing strong earnings growth, MIC, as well as SP Setia. Dividend yield is a simple thematic, just looking at stocks that are giving dividend yields of above 4%. That are Shariah compliance. So this will appeal to investors who are looking for a high return for their cash. Topping the list here is Top Glove because of the special dividends. A lot of the glove makers are also giving a good dividend payout given their strong earnings. So they are showing very high dividend yield in our screening analysis. Tourism play is if you're looking at a play on the reopening of the borders, then we think healthcare could benefit from medical tourism, consumer can benefit from increased footfall. So this would be some of the stocks we were looking to play or to invest into should we start hearing signs of the reopening of the international borders. And the last theme is, if you purely want to screen for stocks with highest upside among all those 7 themes that we have, if you take all the names that we have talked about in our earlier 7 slides, and you just say, I just want the highest upside. So then, based on our and this target price upside, this we get is number 1 here in this list. Okay, risk. I guess increase in COVID-19 will be a key risk of investing in the market and potentially, we will have to consider remain high. Another key risk obviously is politics, and of course, setback of the vaccination timeline will be some of the key risks I would highlight going into market investing in 2021. Earnings risk, of course, if we have a longer period of movement control order, then there could be impact to our corporate earnings growth. So we have to look at earnings risk as well as part of our investment in 2021. COVID cases, of course, something that we have to track because they do have an impact on the performance of the market as well if it's prolonged. And outflow of foreign funds have been one of the key reasons why market has not performed well before last year. You can see that foreign funds have been leaving the market. Our foreign shareholding now is very close to the global financial crisis low. So in terms of downside, we think potentially limited. Now, market is currently trading at around 15.4 times PE valuations. Is currently trading at roughly around 1 standard deviation below the mean. And this basically is a sharing of the sensitivity of the market. Currently, we are targeting the KLCI at the end of 2021 in terms of index at 1759. This is based on 16.2 times forward PE. If we have more liquidity coming into the market, it can potentially trade at 1 or 2 standard deviation above the mean. If we do have a lot more risks like COVID-19 cases or perhaps a vaccination program coming in much later than expected, then market seeing that risk could potentially price the market at 1 or 2 standard deviation below the mean, and these are the index target level. We will be guided when we look at some of these risks and upside potential. I won't go through perhaps in details our economic projection, but basically for 2021, we are assuming the economy is going to grow by about 7.5%, but we have not put in the impact of the MCO into our forecast at this juncture, and our economists do highlight that if we have 2 weeks of MCO 2.0, our rough estimates is that it could shave off about 0.7 percentage point from our headline GDP growth forecast of 7.5%. Okay, and we have also provided some technical analysis in this particular report. And this is outlook for the FBM Hydra Shariah Index going into the later part of 2021. Now, this page basically is our top pick for the big and mid cap stock, as well as our top pick for small cap pick for small cap stocks. So basically, small cap stocks are those that are having market capitalization of less than RM 2 billion. In terms of sector weightings, currently we like the glove makers. They are overweight in our strategy. Healthcare, also an overweight. Media, oil and gas, packaging, semicon, AMS are all areas where we like in terms of a sector pick, and we have underweights for the chemical and transport at this juncture. Now, in terms of top 3 picks, for Shariah, we will highlight 3 stocks. So this is a balanced portfolio where we have defensive, we have growth, and we also look at stocks that we think have momentum in terms of earnings. So I think the first stock we like is Inari. We think the earnings growth momentum is going to be strong going into this year. We are looking at 3-year EPS CAGR of 30%. We have a target price of 370 for Inari. Our top glove is our top pick in the glove sectors. We think that top glove will benefit from strong earnings due to the high ASP for glove. We think that at this juncture, it looks cheap at 6.2 times PE on CY21. And of course, as I alluded to earlier, they also have a good dividend yield. And telecom is our pick on the top pick in the telco space for strong earnings. And we also think that dividend could potentially be good in the upcoming quarter, and earnings also could potentially be stronger than expected. We have come up with a note to upgrade the target price today, and we have an ad call with a revised target price of 7 ringgit for telecom. So those would be our 3 Shariah topic for 2021. Okay, with that, I would like to end my presentation and pass back to Rashtan for the rest of the event.
Okay, thank you. Thank you, Ivy. We have, a couple of minutes. If anyone has any questions for Ivy, can please type and post them in the Q&A box. But Ivy, from your slide presentations, right? Am I right to say that we're gonna likely to see the Shariah outperformance to continue in 2021? Because I don't think like banks or gaming or probably might do well this year. Please, you can unmute yourself, Ivy.
Yeah. Okay. Thanks, Rush.
Yep.
Thanks for the question. So I think for the first half of the year, we are looking at the tech and the glove makers to do quite well. So they could outperform the banks in the first half, because I think in terms of recovery, we could probably see, the recovery play coming back. I think we also have written in our report, perhaps in the second half of the year, simply because I think a lot of people are looking at the vaccination program. If they have confidence, the vaccination program is going to hit the target timeline that we're talking about, say first quarter of 2022 to achieve herd immunity, then I think people will start going back into the recovery play like banks in the second half of the year. So currently, I think the banks are just taking a little bit of breather, whereas the tech are getting quite a lot of good news flow on corporate earnings, and they are outperforming at this juncture.
Okay, just a quick 2 questions before I let you go, Ivy. Will top glove target price be affected by the short selling RSS by the investment banks? And then after that, on the healthcare stocks, do you think healthcare stocks can still do well as there's a shift to cyclical stocks at the moment?
Yeah, okay. Thanks for the question again. I think top glove, of course, if there's heavy RSS being put in place for top glove, then there could be pressure on the share price in the near term. This we have seen in the first trading day of this year. But I think now, the last I checked, perhaps, there's close to 3% of short selling on top glove shares. So in terms of seeing the same volume happening on top glove share going into the next month or so, perhaps it's limited because there's a cap at 4%. So yes, it will affect, but given that we already have about 3%, close to 3% RSS, I think the dampener from RSS may be limited going into the next few months. With regards to healthcare stocks, For glove makers, I think they will still see a relatively good ASP even post COVID. At least that is our projection. Although ASP may fall, but they will still deliver better earnings than what they saw before pre-COVID. So we have already accounted for that possibility in our forecast, and they still look attractive. That's why we still have an ag call. As for the hospitals, I think they could potentially recover or show better earnings when the COVID situation is contained, simply because they could then get back some of the medical tourism that they've been losing over the past year. So that is where we are seeing in terms of catalysts coming from healthcare stocks to outperform, even on the recovery phase of COVID-19.
Excellent. So in the interest of time, there's a quite a number of questions that we'll try to answer them offline after this. But just one last one before we move to our first corporate presentation, Ivy. What is your opinion for some of the stocks which do not comply with ESG? Because I mean ESG is also a big theme going forward, right? So some funds have started to dispose these stocks. Will it drive prices lower? I think for example, I mean in the oil and gas space, Tenaga, which have some ESG concern. Ivy?
Yeah, thanks again for the question. So yeah, obviously if the stocks have issue with ESG and they are big holders of the stocks that are looking to, reduce their positioning in the stock in the very short term, you may see heavy selling in the stocks that may lead to share price underperformance. I think some of the sectors that have seen, or some of the stocks that have seen, selling from funds due to ESG include some of the plantation company in the past, Tenaga because of the exposure to coal. But I would say that once this selling has subsided, because there's only so much that some of these funds own, then the issue perhaps investors will be looking at is, if there are positive earnings momentum for some of these stocks beyond the selling because of ESG, which could be short term, will investors come back and participate in these stocks? So we think that there is opportunity, because I think in the ESG space, investors are also giving opportunity to companies to improve their ESG performance. So I think, for example, Tenaga having a plan to reduce their coal exposure. So at some point, I would say some of these stocks with ESG issue could make a comeback. So we would not exempt them from our topic purely just from ESG, although we would highlight the risk to investors that these are the short-term risks and there's a chance that they may not perform because of selling on ESG perspective. But if the stock demonstrate improvement in ESG, then I think it is worth to relook at them, because they're cheap and they could make a comeback from the ESG perspective as well. So I will not rule out any stocks from ESG perspective also, but would highlight the risks.
Okay. Excellent, Ivy. I think that's all the time we have for your session. Okay, in terms of the recording for this session, you can, it is available. You can just go to our FB page and watch the recording. And also for the presentation itself, we will share with all the participants. We can email the link to all of you. So now we're going to stop the sharing on Facebook Live. Okay, for those that watching us through Facebook, you can actually join our corporate presentation by registering and we'll registering through the link, and you'll be automatically brought into the corporate presentation space. So okay, without further ado, the next corporate presentation is MPI. I will, pass the mic over to Shanas, who will be the moderator for the next session. Okay, Shanas, over to you.
All right, thank you, Rashdan. Hi, good afternoon. Welcome to Shariah Investing Corporate Conversation 2021, brought to you by Bursa Malaysia and CGS-CIMB. I'm Shanas, the tech analyst for CGS-CIMB. Thank you for joining our first corporate conversation with Malaysian Pacific Industries. This afternoon, Malaysian Pacific Industries, or better known as MPI, is one of the largest semiconductor assembly and testing house in Malaysia, serving multinational semiconductor chips makers globally. From the company, we are honored to have Mr. Manuel Zaragoza, Group Managing Director of MPI, and Mr. Rohit Kumar, MPI Sales and Strategy Manager. Thank you, Manuel and Rohit, for taking the time off to speak to us this afternoon. For today's agenda, we will start with a presentation by Rohit to give an insight into MPI and its operating environment. Then we will proceed to Q&A session. Some housekeeping rule before we start. Please mute your microphone throughout the calls. And you may type your question in the Q&A box at the bottom of the screen, and we will address the question to the corporate presenters during the Q&A session. So at this time, I would like to hand the floor over to Rohit.
Thank you, Shanaz. Good afternoon, everyone. Our GMD, Mr. Manuel Zaragoza, would be taking you all through the MPI slides. So let me just share my screen and allow Manuel to speak on MPI. I hope everyone can see the slides now.
Okay. So good afternoon to you all. First of all, thank you for CIMB Bank to invite us to this event. Now I would like to give you in the next 20 minutes a review about Malaysia Pacific Industries. I will not give any numbers because I'm in silent period. So it's more about our strategy. So next one, please. So Malaysia Pacific Industries is not a young company. We actually started in 1972, and we are 100% Malaysian company, and we are selling 100% outside of Malaysia. So all our customers are outside of Malaysia, but we are 100% a Malaysian company. I'm very proud of it because we are also the biggest employer in Ipoh. We are Shariah compliant and we are part of the Hong Leong Group. MPI has two different business inside. One is Kasem, it's an OSA company, and one is Dynacraft, is the lead frame. So they are doing lead frames. Such as said, we are the biggest employer in Ipoh, Perak. And we have a long-time relationship with big players around the world in automotive, in mobile, in 5G, in sensors, and so on. Next one. So Malaysia Pacific Industries has sites, one in Penang, near the airport. Two sites, we call them M site and S site. M site is the older one, we call the mother, and S we call the son. So it's a little bit younger. These both are in Ipoh, and then we have one in China, in Suzhou. Actually, there you can see one level, two levels actually. We put now another level on top of it. We put it last year, we decided in March during the pandemic that we will expand. And 1st of October, we had actually the inauguration, and the machines are slowly coming in, and we ramped up there also now new packages. Our applications where we are very strong, where Malaysia Pacific Industries is really, really strong, is in automotive. We play the automotive segment and the diesel, but we are very, very strong in the electrical cars because of our power packages and our sensors. We are very strong in industrial, that means in servers. That's why during the pandemic, if you have seen us, yes, we lost about automotive, but we won a lot on the servers. So you could not see a big, dramatic decrease, such other ones, and neither in the profit, we were still profitable. And then we are everyone still in the mobile, but we are focusing more on the automotive, and then we are in the PC, notebooks, and so on. Next one. So now here about past numbers. You can see we're growing. We give all the time a profit. Our Q3, that means January, February, March, is always the lowest quarter, is always in semiconductor in the same way. Why? Because December, Christmas is done, and then Chinese New Year. So it's always the lowest. But you could see that we were going in the right direction. Then came the first COVID lockdown. Still, despite all the things that we paid, and then we paid a lot of things because of the COVID, still we were profitable. And you can see from there, we grew and grew. And I can only tell you, this will be the direction for several quarters because our pipeline is full. So it's time that every pipeline, every project that we have invested in the last 3 years is actually coming and coming faster. And you can see a steady growth, year-on-year revenue 18% up and PAT 52%, despite all the circumstances that we had. You can also see that we have a strong pipeline. We have invested a lot in silicon carbide. We are actually the only OSAT today that is packaging silicon carbide from an American company. So we are their packaging company. So we have really big knowledge on silicon carbide that is very efficient for electrical vehicles and for batteries. So you can also imagine we have here an American car where we manufacture for them silicon carbide packages. We are very strong on radio frequency and 5G, but not on the mobile, honestly, but on the routers, so in the set boxes. We are a world-class facility expertise in sensors. Very interesting. We have also a lights off sensor, so only robots working on the line for automotive. Our main thing is we must be the best in quality. That's why 5 years ago, I pushed heavily on automation. Second thing on automotive, because there you really need to have the best quality. So we do a lot of airbags, the sensors for the airbag. If you fail in one, it's a disaster. People can die. So you cannot have any mistake. And then we have a strong cash position. So if people look, we grew in the last 4.5 years to near 1 billion ringgit cash, 900 something million ringgit. So we have no debts. Our EDR is 100 to 0. And it's a very profitable, growing company with the right technology. Next one. So all this is good, but our customers are international. And actually you started discussing. So we have a lot of projects where we are really in it, and one is sustainability. So our goals are there. I will not go through, but every of this goal is measured every quarter. All the managers get KPIs for it, also me, and we really want improve every time on these goals. It's also very important for our customers and the end customers, and we are focusing there, investing heavily amount in all these projects. Next one. So it's important to make money, of course, and it's important to have the right shareholders. So everyone that is listening here from the 218 participants and also CIMB, thank you for your trust in us. We try always to do the best and give the best to our shareholders, but it's also very important the employees and the community. And during the COVID, you could see it was in Ipoh, big impact, everywhere big impact, but there was really big impact. And you remember last year it started with big issues. So we immediately gave face masks. Lucky enough, last year I was still in Chinese New Year, that was February in Suzhou, and I could see what is coming to us. So immediately we put everything in place end of February in Malaysia, and immediately I bought thousands of masks in China. And so we had lots of masks. I always do a joke, I could have been in the mask business. But we gave the mask. We didn't make business, of course, out of it. That's not we gave a lots of masks, and you can see here, these are the community that we are helping. So if you invest in Malaysia Pacific Industries, and I really mean this, if you come to Ipoh, you will see there are lots of family generations working in the same factory, but we are also very important for the community, for the suppliers, and it's a proudness also that there are lots of customers that never knew where is Ipoh, that they really come to Ipoh, and we do a lot for the community. And these are only some things that the face mask. We invested also lots of money in the canteen to give food and so on. That's also important as a company to have corporate social responsibility. So you're not only investing in a company that, yes, needs to make money for the shareholders, but also take care about their community. That's also Malaysia Pacific Industries. Next one, please. So I think we were one of the first ones, is what I at least understood when they did our audit in semiconductor, that got the anti-corruption for sustainable development. For me, very important as Spanish that was born in Switzerland. You know, everywhere is corruption. You need always to improve the processes. So for us, it's important that our customers know, and most important, our employees know that we are really serious on it. And that's why I pushed very fast this. And I must tell you that suppliers and customers, and I hope also Malaysian investors appreciate this, that we take this very, very serious. And in this way, you will be sustainable also in the future, because you know Malaysia Pacific Industries will not do any wrong things with the money from our investors. Next one. So now that's the most funny part, or the right part for us, is what is our strategy? So I remember 4.5 years ago when I said, I want that everyone recognize CARSEM and Ipoh for automotive, and everyone was laughing. And step by step, customers, step by step, and honestly, we were starting working there on electrical cars. But of course, 45 years ago, a lot were speaking, but there was only plans. But we were starting, and of course, we are very strong in diesel cars, but starting in the sensors, in the power packaging, in the RF, because when you have these electrical cars, or if it is easy to do, there's a lots of semiconductors inside. And here, this is when you see, I put not the sensors. These are not sensors that you can do. These are all sensors that Malaysia Pacific Industries is doing in Ipoh and in Suzhou. So it's not, there is a level sensor or there is a gas sensor. All the sensors we are doing today. I'm very proud of it. And if you want to know more about it, I try always to be updated on my LinkedIn. Every 2-3 days, I put a new case about any sensor that we are developing and why and what is the difficulty. We had also a sensor for COVID test for COVID for an American customer, is also on my LinkedIn. So it's really interesting. And we are very strong on automotive. And now with the silicon carbide that is ramping up, and this company, American company, will have their front end finished around 2023. Then, of course, the volume will be a lot higher. So the good thing is when you have technology where you can do the research and development before than other ones, that's really cool because you have an advantage. And second thing is now other silicon carbide companies, Chinese, where they get a lots of money from the government in China, they immediately came to us and said, hey, you know how to package this. Can you also package this in China? So it's a really good attraction. So I think the silicon carbide with automotive in 2023, we have today, we are doing today, we have 4 lines. One is for an American automotive, so very good, but the volumes are not so big. You can imagine who it is and you know the volumes, but Now when Volkswagen is coming in and Mercedes and Audi and so on, it will be fantastic. So very happy for the automotive segment. Today we do around 29%. I really think in 2-3 years we will be there on the 50%, because now the pipeline is full and it's really coming faster than we thought, because all these manufacturers before they were speaking, and now they really try to go to electrical cars, and that's why all this thing about chip shortage that I can tell you now is not affecting me in this moment, and I can explain later if somebody have a question why. But chip shortage is because they demand now all these chips, and they demand so much, and the forecast that they had 1 year ago was 0. So now they have this chip shortage. But I don't do chips, so I'm not a wafer company. Wafer company will be TSMC, Silterra, Global Foundries, and so on. Till it comes to us, needs a little bit of time. So our pipeline is very nice and full, and we are doing very well. And automotive is right strategy for us. It's nice. You need to have the quality. It's not easy to come in. You need to have the trust. You need to have the technology. When you are in a car, don't change such a mobile phone every 3, 4, 5 months. A car stays there for 5, 6 years. Maybe they do some facelifting, but it stays there, and very difficult that they go out then when they are in with you. So very happy with this, and not a lot can come and play this game, or they need time and lots of research and development and money. Next one. So service, we are very strong in service. So our power packages are a little bit more efficient than the other ones, but it seems, it seems nothing. But when you go such server farms, I'm speaking really big server farms, so the ones from Microsoft, Google, Amazon, and so on, you can save $5,000 per server. And it's a lot of money. And when I invest in this, I put this in a silicon carbide, I can at least 30% save. So imagine, will be big savings also for them. And we actually, that helped us a lot during the COVID time last year, and still is very good because everyone went to home working, homeschooling, and so on. So all the server farms, cloud, and so on were very strong. Next one. So we are still in the mobile business. So I will not say that we are not in the mobile business. Most is 5G, most is testing. So the testing is a totally different testing than you do today. You need different machines, different equipment, different processes, because it's different. But we still are in the mobile. But that are not advanced packages. That are standard packages. Where we have advanced packages is on the set box. So the router, the router that you have. There we have advanced technology in RF, in radio frequency, and in power packaging. So that will be also very, very good for us. And it is actually, it started in China, I must tell you. The rest is only speaking, still not doing. When China started, we delivered the first 4,000 pieces for 5G and 6 Wi-Fi 1.5 years ago. To Beijing, and amazing. It's a really amazing technology. It's really, I don't know, the people that have a new MacBook Air M1, they know how fast it is. I tell you, it's a lot faster than the M1. So it's amazing technology. That will really change a lot of things in the world, such LiDAR, such driving, autonomous driving, and so on. Okay, next one. So then what I always said, this is about our technology, what we have today, and we are also looking for the future. So we are really embedded in silicon carbide. Really proud that they chose, or that we could show them that we are the right partner for them. And now also Chinese are coming and starting, and of course, far away of the technology and the patents of this American company. But it is really cool stuff that we are doing, and it's helping us and open us a lots of new opportunities that in the future people will understand how great it was that this comes to Malaysia Pacific Industries, and in IPO. So I think this will be an amazing thing. The next technology, what will come after this, but this will stay 10 to more of the years, and come gallium on gallium. That will be the next amazing. There are some startups, I'm looking now on it, but first let us make money with silicon carbide. Then in the future, we discuss with other things. Of course, we need to invest in the future. So we are investing today in modules and SIP technology. So modules is very important, not easy, but it's very important. I mean, not easy to do. Of course, it's not easy. Nothing is easy what we are doing. But I mean, there are hundreds of thousands of different modules. Every company wants different things, such cables, you know. Now the iPhone came with the new 11 different cable, and you cannot use more the 12. Sorry, the 12 came, and you cannot more use the 11. Here's the module, it's the same thing. Everyone wants different modules, and gets complicated. So we are looking to acquire a module company. We are also looking 3D printing. Why? Everything, when you look and you go to my LinkedIn, I repeat, there are lots of videos also. It's very, very tiny. So you do miniaturization, and actually you cannot see it more. So the only way to stack this, because you have now stacking, you do more on top of it, you can only do this with 3D printing. So we are exploring this, but still on the beginning. So please don't take now and then write to me, oh, they have invested in 3D printing. No, it's only future. I know we need to go there, and where and so on. I still don't know exactly, but we need. And then we are looking for a design house, because you see, we can stay here as an OSAT. We are not a big player. Yeah, we are growing nicely. Our strategy is profitable growth. It's not only growth, not only profit, it's profitable growth. I think we showed this every quarter in good times and in bad times, but we need to grow. And I think a design house we should have. That's the right way. Next one. Okay, so why everyone asks me all the time, first thing is how we can have this quality. Second thing is how we can have this different profit than other ones. We are always around 14, 15%. The nearest is always 6%, how we can do it. First thing is we invest a lot in automation, huge amount in automation. Why? Because people make mistakes, machines don't make mistakes. Second thing is, when I started, we had around 13,500 people for all the Karsem family. Now we have around 7,200 people, and it's not that we took anyone out, nobody. It's only people leave this industry and they go and prefer to work in Tesco or somewhere else, because you know it's very tough. You cannot have WhatsApp. You cannot. You go to a clean room. You see, you need to put in. The ladies need to take all the makeup out. It is a tough place. Quality is very important. You cannot make mistakes. So it's very tough environment, and less people want work in such environment. So we lose a lot of people. Then we train a lot of people. We make a lot of trainings. I told you we invest a lot in the community. We have a lot of relationship with universities and with schools. But we train. We make really a lot of investment. But then other ones take our people. It's how it is, and it's how it is. But that's why I invested a lot in automation, and it pays off what you can. So you also see that we invest a lot in HR, and here you see all these awards. We really need to fight for everyone that can work, and of course we don't take everyone, so they need to have at least the right mindset and of course the right qualifications. But we have a lot of programs to certify them also. Okay, next one. And then now that's my last slide, financial. This is not future, so then future will come in end of February when I give the results. But here you see it, the revenue is up in ringgit and in US term. Do not forget, last year it was 425, 420. Now it's 405, 407. RM is, I think it was 7. Now it is 646, 640 something. So that is always an impact, huge impact actually if you do. But still, we were growing. You see in PAT 52% higher. And do not forget, we were not doing bad last year. We did actually very well. Most of all the companies were in losses. We were still doing very well because we had a good portfolio. still we are growing 52% against Q1, 80% against Q4. Our EPS low higher, you see the number. Net cash increased from 826 to 943, and we invest huge amount of money in capex. Our capex investments is really crazy the last quarters, and I must tell you, it will go in this way for a lot of quarters in every of my places, also in Ipoh, M site, S site, in Suzhou. We are now looking for new land in Suzhou, and do not forget, I only inaugurated 1st of October my 2nd floor, so I need to look for new land. So it's really great, all the different problems, good problems to have, but you still need to do the right things. And of course, the challenge, I must tell you, it's the coronavirus. I think everyone spoke before. You never know what will happen. It's spreading, and also now in Ipoh, I was very proud. I must tell you, I was very proud that we had not one coronavirus till December, and now it started. When I'm looking the movies, the CCTVs inside, not from people inside, they come always from spouses, from outside. But there is always 1-2 people maybe. Of course, we know how to do the quarantines and so on. We work always close with KKM. But it's there. The virus is there, and that's my main challenge in this moment. But the rest, I feel very confident for next quarters and years, actually. That was my last slide. I used my time. Thank you for listening. And yeah, thank you also, CMB, another time for the invitation.
Thank you, Manuel, for your insightful presentation on MPI strategy. So now we will proceed to Q&A. Allow me to start the ball rolling with the first question. So Manuel, I think a lot of investors are excited about the potential of growth in semiconductor content in automotive industries, and we know MPI is in good position to capitalize on this trend. And can you just elaborate more about the strategy to grow this automotive portfolio over the next 1 to 3 years? And is there any target, like in terms of revenue or growth percentage, that you can share with us?
Okay, thank you. You see, we have started 4.5 years ago, so nothing has changed in our strategy. I always said we will focus on automotive. It needs time. Automotive is not an easy game. You really need to trust. Till you have a project, you need to put a lot of engineering, technology, and money. So we were filling our pipeline for electrical cars 3 years ago. And now it's coming actually faster than I thought. So this is one strategy that we did 4 years ago, not now. So the ones that start now is too late. They will need to wait for another 4, 5, 6 years. And then the second thing is the silicon carbide, because will help in power. That definitely will help in the battery. That is the next thing what we are doing. And what I'm aiming is 50% of my revenue in automotive, because yes, when you have a problem, it's a big problem, I agree. But when you don't have a problem, it's also honestly a good business to be in, because margins are okay, never happy, but margins are okay. Technology, you play really cool things. You need to have the quality, but you never lose because somebody comes with cheaper price and then you are out of the business, such mobile. So that my aim is to have 50% in 2023 and 2024. And it depends honestly how fast all these automotive customers really push their electrical vehicles and if they get chips. But I'm okay still today. I have a lot of projects that we have booked years ago that we have the wafers, so nothing has changed. Only now the volume is 20, 30 times higher what they demand, and they will not get it because the chip factories, they need 1.5 years to 2 years to build up a new factory. Don't go so fast. But we have no issue, zero.
Okay.
So I hope I explained our strategy. 50% of my revenue should come from automotive.
I mean, you touched a bit about silicon carbide, right? So how big is it going to be? I mean, we know right now automotive is about 30%. So is it the next 20% entirely going to be from silicon carbide?
I don't think they will have so many wafers. Do not forget, today is one player in American that changed now the name to the other name. Actually, I can say the name because I have no NDA with them. It's Wolfspeed, it's Cree, and it's Wolfspeed. I can only not say one name in America that is a flu company, but this one I can say. And they are the only big players. They start in 1985, they have the patents, and they invest now, I think 1 billion in the state of New York for a new fab. I saw some pictures. They will need 1.5 years, 1 year till finish it. So the other ones are coming. So I really do not know. It depends how much wafers you get, but we are ready. So I'm ready. If they give me more wafers or anyone gives me more wafers in silicon carbide, I'm the only one today that can do it. So I'm very happy.
But if I can just add on that, how would you balance between growing silicon carbide with Cree and without having to expose MPI into a single customer dependent series? I mean, are you going to limit yourself?
So your question is how dependent I am today with them, or?
Yes, and going forward, are you going to limit, let's say you reach 10%, then you won't do anything for them?
No, but you know how this works is that the Chinese are building factories. So there comes a new, I can also say the name, I have no NDA there, Innoscience, it's called Innoscience Chinese. They got 1.8 billion from the government. They have built actually near the factory is finishing. So they want to start with their first wafers taking out next year. So it's coming very rapidly, but of course the technology is such, you would tell me TSMC and some other ones is still far away, but you know that Chinese are smart people and they will be very fast. And then do not forget, there will come a lot of other ones that will try to get in this market. So you will not be dependent on one, definitely not.
Yes, I mean, you touched a little bit about Chinese company, right? And can you just elaborate how are you benefiting from this Made in China 2025 initiative?
Yeah, so our strategy was another time different than most of other ones. So 4.5 years ago, I had only standard packages legacy called legacy in China. So what normal was you give the legacy. So I did different. I actually wanted to be automotive also in China because the biggest player in automotive electrical car is not in America and Europe. It is in China, BYD. It's amazing big. Everyone speaks about all the other cars, but nobody speaks about BYD. BYD is by far the biggest electrical player. So I wanted to be in China, actually. If you look at the consumption of Chinese, it's huge. So we put every technology, the best technology in copper clip, in sensor, in the flip chip, everything what I could, I put in China. So what I was playing, I was not playing price. I was playing their technology, quality, and service. Now, why it benefited us as non-Chinese, we are not Chinese, or if we are there, but we are not the Chinese, and we have no friendship or no relationship, there we are still a foreigner. Why we are successful in China? The first thing is when the Americans, about this trade war, American Europeans could not more sell their products, they needed a really strong OSAT, because you see, if you have not really highest quality and you are normal, then you need to have an amazing package. So they came to us because we know how to package this thing and we know to tell them, oh, that will not work in this way. We need to do it in this way. So they came and then they stayed. And I tell you, 5 years ago, my top 5 customers were American and European. Today, all are Chinese and growing such hell. All are Chinese. Not one is more top European or so. All are Chinese. So it's amazing story in China, and will be for the next years, if not long. China is doing the right long bet.
All right. I think I'm sorry, Manuel. I think I'm afraid we are running out of time. It's already almost 3:30. Okay. So I think with that final comment, so yeah, I would like to end our first corporate meeting session here. And I would like to take this opportunity to thank you, Manuel and Rohit, for sharing the insight this afternoon. And thank you to all participants who have joined the session. Please stay tuned for the next session with Axis REIT. My colleague Sharizan will moderate the next session. Sharizan, I'll hand the floor over to you.
Thank you.
Okay, thank you, Shanas. So now tuning in for our next corporate conversation session at our Shariah Investing Corporate Conference, Conversation Series 1. My name is Sharizan Rosli, analyst for the REIT sector at CGSC IMB. I would like to welcome the line of management from Axis REIT. We have CEO Ms. Leong Kim May on the line. We also have CFO Ms. Nikki Ng. We've got Head of Real Estate, Ms. Jackie Law. We have Head of Investments, Mr. Tan Ki Hong. Ki Hong, how are you? And finally, we have Senior Manager of Investments and IR, Ms. Chan Ziwi. I believe the management is ready to start the presentation. So without further delay, I will pass on to Ms. Leong Kim May and Ziwi to set up the sharing screen for the slides.
Okay, thank you, Sharizan. Thank you, CIMB, for hosting the call today. We will share our slides. Okay, I'm waiting for it to be uploaded. Okay. Okay, we are ready. So today's presentation will be split and will be taken over by a few of my team members. So today we will cover a few areas. Zivi, can we change the next page? We'll talk about the business overview of Axis REIT, followed by our year 2020 highlights. As we have just announced our fourth quarter results a few weeks ago. And then we'll move on to the portfolio overview in terms of the portfolio of assets that Axis REIT owns. Together with, we'll discuss about the investment activities that the REIT has been undertaking and the assets that we're looking for, especially. Financial overview will also be covered by our CFO. So in terms of business overview about us, right? Axis Real Estate Investment Trust, or better known as Axis REIT, we are Malaysia's first real estate investment trust that's listed on the 3rd of August 2005. In year 2008, December, we have been reclassified as an Islamic REIT. In the reclassification of Islamic REIT here, we actually have to comply with specific guidelines as issued by Securities Commissions. There's a specific guidelines for Islamic REITs, and we have actually been duly complying with that in order to fit for the reclassification as an Islamic REIT. Axis REIT, we invest primarily in Sharia compliant industrial and office real estate assets. Our primary objectives of the fund are to provide unit holders with a stable and growing distribution of income, and we also achieve long-term growth in the net asset value per unit. Talking about the distribution of income, we have a quarterly income distribution policy where every quarter the REITs will be distributing our income to our unit holders. Next slide. So this is a typical corporate structure of a REIT. So Axis REIT, this is where we are. The Axis Real Estate Investment Trust, we are listed on Bursa Malaysia. It's a listed fund. And we have on the left-hand side, top left-hand side, we have the Axis REIT Managers Berhad, the manager that manages the REIT. This is where we are all working for, Axis as the part of the manager. And we've been advised by our Sharia advisor, BIMB Sharia advisor. And on the other side, you will have the unit holders that invest their money into the REIT. And we have the trustee on the top, on the bottom right-hand side, we have the Arbitrary Trustees Berhad, the trustees that ensure the interests of the shareholders are duly protected. And whatever, the trustee is also there to actually ensuring that all the assets of the fund are being held as a trust, in the trust that is held under their name as well. So all the assets that Axis REIT invested in have to be Sharia compliant real estate. Yeah, and we have a property manager, a licensed property manager that manages all the assets that we have. So next slide. Okay, so in terms of the business of the REIT, so really what does Axis REIT do, right? So importantly, we are very much in the landlord business. So the key thing is that we're in the leasing business. SICC REIT offers a huge range of industrial and office space in strategic locations to suit our business needs. So on top of listings, we also acquire property. So in order to ensure the portfolio continue to grow, and we have a good offering of space that we can offer to our tenants. So acquisition is also an area where we focus heavily on. And the last 3 years, we have started to embark on the build to suit offering to our tenants. A lot of MNCs, when they come to Malaysia or when they wanted to expand, they actually will prefer to have a facility that built to their need. So this is where we come in, we build to the specification of their need, and in return, they sign a long lease with SICC to ensure the shareholders of the REIT continue to enjoy the continuous recurring income. I think so far we have achieved 3 build-to-suit development. The first one that we have achieved, completed, is actually the development of Nestle Distribution Center, 500,000 square feet that we have completed, followed by another built in Subang Aerospace Company, Senior Rebecca, 178,000 square feet of facility. And recently, last year, we have completed another development for FedEx in Batu Kawan. Yeah? So that is what we do as a business. Okay, next slide. So for 2020, right, last year, in terms of the highlights that we have achieved, as you know that the number of properties in the portfolio at the end of December, as we have announced 2 weeks ago, we have 53 properties and 41 of the properties have 100% occupancy rate. Our total assets under management is 3.36 billion ringgit. We have a space under management of 10.5 million square feet. Financing ratio is 33%, right? And our portfolio very much focused on industrial space, and 92% of properties are sitting on industrial titles. Our occupancy average is at 91% as the end of last year. Our weighted average lease expiry of 5.7 years across the portfolio. And let's say we have been classified as an Islamic REIT in year 2008. Our total distribution per unit last year was 8.75 cents per unit. Our market capitalization was 2.93 billion ringgit. And nationwide presence across Malaysia. So all the 53 properties are sitting in Peninsular Malaysia itself. On first quarter 2020, we have completed the acquisitions of one property in Milan for 15 million ringgit on 28th of February. The third development that we undertaken in Batu Kawan for FedEx was duly completed and handed over on time to them, and the rental has commenced on 1st of March 2020. We have also completed the acquisition of SICC Facility 2 at Bukit Raja for 37 million on 17 March 2020. So in second quarter, we completed another distribution warehouse in PTP, Johor, for 65 million on the 9th July 2020. Fourth quarter, we also see the completion of acquisitions for 2 properties in Shah Alam, in fact, one for 95 million on the 10th of November, and the second one was completed for 11.87 million on the 3rd December. So actually last year, all the properties that we have completed are all industrial properties. Because in terms of focus, in terms of acquisitions, expansion, growth, we're all actually looking at industrial property, especially in the area of warehousing. Next slide. In terms of financial highlights, we have declared a DPU of 8.75 cents last year, and we have 19 million revaluation gain recorded for 2020. So what the REIT does is that every year we have to revalue our properties for fair value to ensure the fair value is being reflected in the balance sheet. So last year we have recorded 90 million revaluation gain. Our investment properties stood at 3.28 billion ringgit. Our net property income increased by 3.6% last year as compared to the year before. Our realized net income also increased by 8.5% in year 2020. We have also announced the implementation of the income distribution reinvestment plan in conjunction with the payment of the 2020 final income distribution. Our share price at the end of last year traded at a premium of 38% to our net asset value. Our number of unit holders has also been increased to 6,776 in the fourth quarter as compared to the third quarter last year. Okay. So on the portfolio overview, I will hand the floor to Ms. Jackie Law, our head of real estate, to walk you through. Over to Jackie. Jackie, you have to unmute your mic.
Sorry. All right. Good afternoon, everyone. I'll take you through to the portfolio overview. During 2020, we added 5 properties to the portfolio, bringing space under management to 10.5 million from 9.5 million square feet. So this was the acquisition was highlighted by Kit May earlier on. Okay, next slide. All right, we have 53 properties, all located in the industrial areas such as Klang Valley, Johor, Penang, Pahang, Negeri Sembilan, and Kedah. Our focus pipeline is still the industrial hubs in Penang, Selangor, and Johor. In terms of location, as you can see, the largest cluster of property is still located in Selangor. We have 54%, followed by Johor, we have 26%, Penang, 8%, Pahang, 5%, Negeri Sembilan, 6%, and 1% in Kedah. Okay, next. All right. In terms of industry exposure, what you can see, our dominant is still the manufacturing and logistics, which we have 32% in logistics, 31% in manufacturing. So all these users are pretty much into halal or Sharia compliant. Yeah. So the next one is the industry, the property type. Again, you can see the largest cluster is still the logistics, followed by manufacturing. We have a cluster of 15% for office industrial and a 5% cluster of office space. Hypermarket consists of 3%. In terms of usage, we have a single tenant, one tenant occupying one property. We have 74%. So this 74% single tenant provides stable long-term organic rental growth. And these leases are typically long-term leases with pre-negotiated rent step up. So 26%, that's the balance, are occupying the multi-tenant buildings. Next. Okay, this has been summarized earlier on. We have 10.5 million square feet of space, 150 tenants, number of properties, 53. Property income recorded was 224 million. Property expenses, 33.7 million, and giving us the net property income of 190.3 million. Occupancy rates stand at 91%. In terms of efficiency ratio, is still between the 15% region. So in 2020, we recorded 15.05%. Yeah. Okay. We monitor our leases. These are the leases coming for renewal on a 3-year basis. So in year 2020, you will notice that we have 1.7 million square feet of space. Out of this, we have already secured renewal for 77% of the space and 3% secured with new tenants. So in a way, 80% of the space from 1.7 million square feet has been re-tenanted. Okay. As for year 2021, we have 1.9 million square feet, which is about 18.6%. Yeah. So we are already renewing some of the tenancies, and to date, we have done about 1/3 of the renewal. Yeah. Thanks. Next. Next. Okay. These are the occupancy rates of buildings with below 90% occupancy. As you can see, most of these buildings are in the multi-tenant buildings. So multi-tenants, we have tenants who move in and then tenants moving out. Okay. From this particular list, one of the building which has been in the highlights of all the fund managers was Quattro West. Last year, we managed to secure 100% tenancy. So the building now is fully occupied. It's an office building. As for D8 logistics and also Asia Axis Industrial Facility at Rawang, these are single occupied property. So we are in negotiation with parties, and we expect the deal to be closed soon. Thank you. Next. Okay, top 10 tenants. From the top 10 tenants, as you can see, the top 10 tenants consist of logistics company, manufacturing. We have the Number one is Nestle into consumer products, LF, Schenker, Post Logistics, Northport, they are all into logistics. Yongnam, Wasco, Obeka is into manufacturing, and of course, Tesco is into hypermarket. Yeah. So you can see the biggest cluster is still Selangor, which occupy 54%, followed by Johor, 25.7%. So these are all the focus point of industrial assets. And this particular top 10 tenant contributes 46.75% of the total revenue of the trust. Next. As highlighted by Kitme earlier, we have done the third build-to-suit project. This project was done for FedEx, and the property was completed within 5 months. It's a 44,000 square feet in Batu Kawan. So we are now have a 10-year lease with FedEx. Next. I have completed my section, so I'll pass on to Ki Hong on the acquisition. Thank you.
Thanks, Jackie. So just going through the completed acquisitions that we have done over the last year. As you can see from our earlier summary, we have completed close to 260 million of acquisitions in 2020 itself. I will bring you all through quickly on what we've completed thus far in 2020. As you can see, Access Facility 2 in Negeri Sembilan, Nilai, is a 246,000 square feet facility, which is housing our tenant, K Plastics. It's being used as a manufacturing facility for plastic, manufacturing plastic bottles for consumer goods like Johnson & Johnson, and also for some of the other pails and tanks, diesel pails as well. As you can see here, we've got a good occupancy rate of 100%, and it comes with a goodwill of 10 years. We acquired it for a price of 50 million. Access Facility 2 at Bukit Raja Klang. This one is tenanted to Lion Steelworks. The facility is being used to manufacture steel cabinets. And as you can see here, it is located in a very good location in Bukit Raja Klang. We acquired it for a price of 37 million. Comes with a shorter WALE of about 2.5 years. But what we have done in this deal as well is we've collected, I think, 2 years rental upfront, and also the deal comes with a 5 months deposit. Notwithstanding that, this particular facility is located in a very good location in Bukit Raja Klang, and we've got a good 5.57 acres land there. Next slide, please. The third one is D37C Logistics in PTP Johor. This particular facility is tenanted by Schenker Logistics. Okay, it comes with a goodwill of 8 years, and as you can see, it's a large facility and with the proper raised floor, and also docking area for the 20 footers, 40 footers. So comes with, I think we've acquired it for a price of 65 million, and we've got a very good tenant in this particular facility, which is Schenker Logistics. The fourth one, which is also a logistics distribution center in Section 15 Shah Alam. We've acquired it for a price of 95 million. It's a very sizable facility of 10.4 acres located in prime area of Section 15 Shah Alam. It's very near the commercial area of Section 15 as well. And the net lettable area is 285,000 square feet. It's tenanted out to a logistics, third-party logistics company called One Total Logistics, Sendirian Berhad. The WALE is about 3 years, but for this location, I think there's constant demand for from logistic and third-party logistic players for spaces here as well. Next slide. The fifth one is also located in Section 15 Shah Alam, Jalan Pengapit, Shah Alam. So the facility is slightly smallish, 41,000 square feet. It's currently tenanted out to a company, construction company for the fabrication and storage of their construction materials. We've acquired it for a price of 11.87 million. It comes with a WALE of 3 years. And what we like about it is the property is a bit aged. So there's definitely an opportunity for us to refurbish and reposition this particular facility when the existing tenant moves out after the tenancy of 3 years. The sixth one is Indapura Facility 2 in Johor. This facility is acquired, is located in iPark. Okay, we acquired it for a price of 8.54 million. is tenanted to KES International Sdn Bhd. It's being used as a facility to manufacture burn-in chips. So it comes with a remaining WALE of approximately 3 years. And notwithstanding that, the location for this particular facility is in a modern industrial park, and it's located in a very established industrial area as well. Okay, next slide. So I'll brief you through to some of our ongoing acquisitions. The first one is Bayan Lepas Industrial Facility 1 in Penang. Okay, it's a 78,000 square feet facility located in the prime area of Bayan Lepas. We're looking at a land area of 2.1 acres here, and it comes with a leasehold tenure, and it's being tenanted by Pentax Medical. They're using this particular facility for the manufacturing of scope imaging lenses, and they are also a subsidiary of Hoya, which manufactures your contact lenses. So what we like about this property is definitely the location, and we've got a good tenant in Pentax as well. So we're looking to complete it within this year, and hopefully upon the completion, we will definitely let the market know as well. The second one, Manufacturing Facility 1 in iPark as well. This one was acquired, and with another one in iPark is acquired together with the one that I mentioned earlier in the completed acquisitions. So for this particular facility, it's tenanted to Perodua. It's being used as an office and also a workshop for Perodua. It's about 25,000 square feet and freehold land. And we're looking to acquire it for a price of 6.68 million with a WALE of 4 years remaining. The third one, Manufacturing Facility 3 at iPark in Indapura. So this is like what I mentioned earlier, the 3 properties that we acquired from Axis AME in iPark. The net lettable area is 57,000 square feet. The land area is about 2.1 acres, and it comes with a WALE of approximately 6 years remaining. It's tenanted out to Bionics. We have existingly 5 other properties from Bionics, which is in the same street. So with this one, we've acquired the entire facilities along the street as well. So we have Bionics A, B, C, D, E, and this one is F. So we've got a good presence along iPark as well. The fourth one is a manufacturing facility at Bukit Raja. Existingly, the property is being used for fabrication of steel sheets. And as you can see, the gross floor area in comparison to the land area is pretty much underbuilt. It's only 36% built of the land. And there's still a good, there's good balanced land for us to put on additional facilities and also to make sure that the facility is more built up. We're looking to acquire it for a price of 120 mil. And the tenant will lease it back from us for 1 year. And upon them vacating the site, there's definitely an opportunity for Axis REIT to reposition this asset and to redevelop this site to fetch better yields for Axis REIT. And notwithstanding that, this is located in a very prime industrial park located in Bukit Raja Selatan. And as you know, line of this size is hard to come by in that area as well. Next slide. The fifth one is a warehouse in Pasir Gudang, Johor. Okay, the net lettable area is 308,000, consists of 2 blocks. So each block is about 200,000 square feet. And similarly, we have a good sizable land here of about 16.23 acres. It's leasehold tenure, and it's currently occupied, 100% occupied to third-party logistic player as well. And we're looking to acquire it for RM75 million. And what's good about this particular acquisition is it comes with a long WALE of 10 years and possibly with a further option to renew for another 5 years as well. So we've got a good exposure here in Pasir Gudang, and as you all know, currently the demand for logistics spaces is definitely the topic of the town as well. Okay. So with that, Axis REIT is still looking for a total estimated acquisition of 135 million on top of whatever that we've briefed you all earlier. Okay, so definitely we are constantly the market to continue to source for grade A logistic facilities and manufacturing facilities as well, with long leases and obviously with tenants with strong covenants, especially in this point of time in the pandemic. And definitely we're looking for warehouses that are located strategically and ideal for last mile distribution. Well, we're still looking at deals that are coming through for offices, but we're a bit more cautious on this sector. But if there's any deal that's hard to come by or it's a very favorable deal, we'll definitely look into it as well. So with that, I pass it on to Nikki.
Yep, thanks, Kihong. Ziwi, next slide. Yeah. Okay, so I will take you through on the financial overview, okay, for our fourth quarter's results, okay. Just a quick update. As you can see from the slide, we actually maintain a strong financial position as at 31st December. So we have a total asset of 3.36 billion, total financing of 1.1 billion, unitholder funds value at 2.2 billion, and also the net asset value per unit is 1 ringgit 47 cents. Our financing ratio is low at 33%, yeah. So in 2020, we have actually distributed 6.5 cents over the last 9 months for the first 3 quarters, and we have just announced another 2.25 cents DPU for our fourth quarter of 2020 last year. And we have also announced the iDrip is actually applied to this final income distribution as well. So the total payout for 2020 is 8.75 cents. Okay, next slide. Okay. As you can see, our distribution yield remains attractive, 4.31%. This is based on the unit closing price of 2 ringgit and 2 ringgit 3 cents on 31st December. So it is much better than the 10 years MGS, okay, 2.63%, and also the 12 months FD 1.75%. Yeah. Next. Yeah, so the chart shows our historical performance over the last 5 years. As you can see, in terms of revenue, NPI, net income, and DPU, the trend for our performance is on the rise, yeah, over the years. So as you can see, we have actually provided our unit holders with a steady and regular distribution income throughout the years. Yeah. Okay, next. Yeah. In terms of portfolio yield by asset type, we deliver a gross yield of 8.8% and a net yield of 7.5% for our total portfolio. Yeah, the warehouse and the warehouse logistic category actually tops the chart with a net yield of 8.3%, then followed by hypermart 8.2%, and also manufacturing facility 7.4%. Yeah, next. Yeah, so the next one, this one is the financial position. So the investment property stood at 3.3 billion as at the 31st December 2020. This has actually increased close to 290 million. Okay, 260 million is from the 5 new acquisitions in 2020. As what Kim mentioned earlier, actually last year actually we have registered a revaluations gain of 19 million, and also we have spent I think almost 7 million on the AEIs during the year. So on the tenants collections, in terms of the average collection period as at 31st December was 14 days, which has actually improved from 20 days in the last quarter, third quarter of last year. So far, we have collected close to 100% in quarter 4 of the rental. Yeah. In terms of increase of the unit holders capital of 11.7 million, this was actually from the iDrip that actually we completed in March 2020. Yeah, this is a net proceed that the capital that actually we retain from the iDrip exercise. Yeah, yeah. I think net asset value is 2.12 billion, and net asset value per unit is 147. Next slide. Yeah, if you're looking at the table, these are the 5 properties that we completed during the year. Okay, last year close to 260 million. Yeah, next one. Yeah, this one I have covered. Yeah, yeah. So this slide is actually to show you our financing ratio as at 31st December is 33%. Yeah, this one, as you can see from the chart, is still giving us a lot of headroom, okay, to further pursue new acquisition in the near future. I think, as you know, recently SICC has also announced a temporary increase in the gearing limit for the REITs, increase the cap to 60%, okay, until the 31st 2022. Okay, even though we are allowed to gear up to 60, but we don't intend to be highly geared. So, yeah, as you know us, we don't even plan to go beyond 50% as a prudent capital management strategy. So we always keep our gearing ratio at a very healthy and comfortable level. I think this will be my last slide, okay, for the presentation. Yeah, okay. So thank you very much. So I pass on back to Sian. Thanks.
Thank you. Thank you all and the SICC management team for the presentation. So let's jump into the Q&A session. I will pick one or two questions in the interest of time. So the first question is, Kime, is how does SICC deal with the effects of COVID-19, where many shops are closed and traders and tenants are unable to operate as usual, and some revenue challenges going into 2021?
Okay, thanks, Sharizan. So on the questions about the impact of COVID-19, in fact, when I think what was interesting was last year during the MCO period, I think for us landlord, I mean, COVID-19, it actually affected everybody, right? So even as landlord, we're very concerned, especially on the tenants' activities and how many of our tenants, are able to operate during the MCO period. Because during that, I think it was around March to April, initial March, I think, when they announced the lockdown, they actually reclassified everyone into essential and non-essential, because only the essential people are allowed to operate during that time. So I think initially the first 2 weeks, we were really assessing the tenants and see how many of them are allowed to operate. And based on what our observation was, that 50% of them are actually operational immediately when the start of the MCO, because most of them are in consumer products, like Nestle, logistics, and they are allowed to operate because they are essentials. So, but subsequently we noticed that 2-3 weeks down the road, and most of the other manufacturers, they actually managed to get MITI's approval to allow them to operate. So subsequently, at a month down the road, they actually have be operational. So I think after that, 70% of our tenants are actually operational. So that was what we were assessing the situation closely. But during that time, our rental collections continued to be strong. I think in the past quarters when we announced results, I think we have also announced that even for that particular quarter, we have actually collected 100% of the rental due. Because all the rental are based on straight rental structure, where it's just pure basic rental, flat rental that we charge our tenants. We don't go by percentage of sales, like how much revenue they make. It translates to additional rental on our side. It doesn't work that way, because we are mostly on the industrial landlord type of business. Really is a flat structure, contractual agreement. So like I say, the weighted average lease expiry of the portfolio is 5 over years. So our portfolio is pretty stable, and we are happy that during that time, the impact is very manageable for us. We do provide support to our tenants during that time. I think for some office properties that we have, we do own some offices. We have 3 pure offices in the portfolio, but the percentage of portfolio is low, it's only 5%. So for that sector with the tenants, we do actually provide waiver in terms of the seasonal car park, because the staff are not coming into park. And for those tenants that are really unable to operate during the MCO, we actually allow them to defer their rental in a way that we know that they are not operating during that time. So instead of March rental paying us by the 7th of March, they actually has flexibility to pay us, I think, a month of April or May. But that rental during the particular period has been duly collected. And I think luckily enough, during the current lockdown that we are seeing, I think essential businesses are allowed to operate. So we also noted that all the tenants, 150 tenants of ours, are still operational as usual.
Okay, thanks, Kime. And perhaps the last question I will take for this session is, what are the advantages of COVID-19 pandemic in transforming SICC business into the future? Any future thoughts?
Yeah, I think COVID-19 is really, it's a global pandemic, and it's impacted everyone, businesses, and even to everyone. It affected our daily lives as well. But what COVID-19 that actually has created a tailwind in terms of a lot of logistics businesses are doing extremely well during this time. I think everyone is buying online and all that. The logistics businesses are thriving, and that pushed up the demand for logistic warehouses. So that logistic warehouses is actually one of the key sector of space that SICC offer, and I think that sector of the business will continue to do well. And if you notice in the last, I think 5-6 years, we have been actively acquiring property in the industrial space, be it in manufacturing or in warehousing. So that has been the key focus even prior to COVID time. So that will continue to be our focus. And that has actually proved that in terms of industrial space, I think most of the industrial space in the portfolio has actually enjoys very 100% occupancy rate.
Okay, great. So I guess that's about the time that we have for the slot with Axis REIT today. I would like to thank you, the participants and listeners, and also Axis REIT management. So now we move on to our third company conversation session. I will pass this session to our glove analyst, Mr. Walter Au. Walter, take it away.
Hi, okay, thank you, Sharizan. Okay, so moving ahead, we are honored to have with us today a Top Glove team. So from the company, we're honored to have with us Mr. Lim Chong Wan, basically Executive Director and CFO of Top Glove, as well as also his associates. So without wasting further time, I'd like to invite Mr. Lim to go ahead with his presentation. Over to you, Chong Wan.
Thank you, Walter, for the introduction. Good afternoon, ladies and gentlemen. I'd like to thank CIMB Securities and Bursa Malaysia for organizing this event, and Top Glove honored to be given an opportunity to introduce the company in this seminar. So at Top Glove, at the start of every meeting or presentation, we'll start off with this TG Business Ethics Labs. This underscore the importance of the good corporate culture of business ethics, which is top honesty, top integrity, and top transparency. So let us do it together. Ready? 1, 2, 3. Top Glove, top honesty, top integrity, top transparency. Quality, quality, quality. Thanks. So first slide is that Top Glove is the world's largest rubber glove manufacturer of nitrile gloves, natural rubber glove, and surgical glove. Our gloves are mainly used in the healthcare industries. Our market cap currently at 53 billion with annual capacity of 93 billion pieces of glove. And our gloves are sold globally to around 2,000 customers across all the countries in the world and supported by 21,000 employees. So Top Glove was founded by our executive chairman, Tan Sri Lim Micha, in 1991. So started with one small factory, but over the years, the company has grown leaps and bounds to become the world's largest rubber glove manufacturer in 2004. In terms of world largest of manufacturer of surgical glove in 2018, and the world largest nitrile glove manufacturer in 2020. And we are listed in Bursa Malaysia in 2001. And has our secondary listing in Singapore Exchange in 2016. So globally, the glove demand has been growing at around 10% annually. And in 2020, glove demand is estimated to be around 360 billion pieces. We expect growth rate of around 25% in 2021. And assuming pandemic ends in end of 2021, so we estimate annual demand to be around 15% growth rate in 2022, which is still higher than the pre-pandemic of 10%, mainly due to the higher awareness of the importance of glove usage, and also more glove usage in the non-healthcare sector as well. So developing country has started to use glove during the pandemic, which will not stop using after that. In fact, the growth rate will increase. The healthcare workers will know the importance of using glove to protect their life, as glove is an essential item in the healthcare industries. Next slide is in terms of the glove usage per capita. If you look at the comparison between developed and developing countries such as US, you have 150 pieces. Germany also has high usage, whereas compared with most of the developing countries, it's less than 10 pieces per capita. That means even in normal situation without the pandemic as well, there is still a lot of opportunity for growth in the developing countries because healthcare spending will increase over the years going forward. So next is on our glove present in every countries in the world with headquarters in Malaysia and supported by our distribution office in US, Germany, and Brazil. And around 60% of our glove will be to the developed countries currently, and around 40% is to the developing countries. So for Top Glove, we produce both natural rubber and synthetic rubber glove. And it's important, being the world's largest glove manufacturer, to maintain such kind of production of both synthetic and natural rubber as well, so that we can export to all the countries globally, because different countries will have different preference of in terms of glove type that they require. Next, in terms of the delivery time meaning from the time of customers placing order and when they will receive the glove. So delivery time, current demand continue to be good compared with pre-pandemic period. Although delivery time has shortened, mainly because of our additional capacity. Around, let's say, nitrile, we have around 20% capacity. And also there is lesser panic buying or overbooking from the customers as well. So it has shortened, but it's still at a very long delivery time as well, compared, let's say, pre-COVID of around 30 to 40 days. Right now, for example, nitrile is around 200 days. Natural rubber is also around 295 days. Surgical glove around 265 days, and vinyl glove is around 40 days range in terms of delivery time. And even with vaccine as well, glove usage will continue, as vaccine will not be available to everyone globally. It may take some time as well. You see. Next slide on the financial. Our financial year end is 31st August, and for first quarter financial year 2021, we have delivered an exceptional good results for first quarter. First quarter revenue was 66% of FY 2020. Profit after tax of 2.4 billion, an increase of or rather 134% of FY 2020 full year net profit. And even in terms of cash flow from operation as well, 3.1 billion cash flow for 3 months period, which is equivalent to 91% of the FY 2020 12 months period cash flow from operation. So a good performance from Top Glove in first quarter. And also in the others on a year-on-year comparison as well. In terms of comparison, in terms of revenue, EBITDA, or even in terms of profit margin as well, we see a strong growth in terms of the comparison compared Q on Q or year on year as well. Next slide is on the expansion plan. So currently we are at 93 billion pieces of glove with 36 glove factories. And for 2021 calendar year, the plan is to add in additional 19 billion of new capacity, or 20% of our existing capacity. And for 2022, it will be 24 billion or 21%. So that will put us at 136 billion by end of 2022. So in terms of expansion as well, we will either speed up or slow down some of the expansion, depend on the demand supply situation. As at now, for the next 5 years, the plan is to invest 10 billion over the next 5 years, which is from 2021 to 2025 for additional 100 billion pieces of glove per annum. Next, on the raw material price movement. So we have seen the price, let's say nitrile raw material price has actually increased significantly over the past few quarters, mainly because of the surge in demand of nitrile raw material, and also the limitation in terms of capacity of our suppliers as well. But over the past few months as well, there is also new expansion from our suppliers. So going forward, we expect raw material, either natural rubber raw material or even nitrile raw material as well, to be more stable going forward for the next few quarters. Next slide is on the performance since our listing in 2001, and our compounded annual growth rate of 28% for revenue and net profit at 38%. So that means we double ourselves almost in average is around every 3 years. We will have double our position, either revenue or even net profit as well. Next, in terms of dividend payout, so we are committed 70% payout ratio from second quarter 21 to fourth quarter 21, and that will be 50% from our dividend policy, which is 50% on PATAMI, and also for the next 3 quarters as well, the 20% on PATAMI. So that make up 70% of dividend for the next 3 quarters. So if you look at dividend as well, you'll be exceptionally high in terms of dividend payment compared with the previous years. On the next slide, we share in terms of the returns. If you are shareholders of Top Glove, since our listing in 7th of March 2001. So total return currently is 31,000 times, sorry, 31,000% or 312 times. So if you have invested 1,000 shares at 2 ringgit 70 cent, then meaning 2,700 ringgit investment in March 2001. So the market value of the shares, 2,700 shares, which after the few rounds of bonus issue, which will be 122,000 shares currently. So that will give you a market value of 800,000 from 2,700 to 800,000 in 20 years period. So a very good return. And next is on the CBP, an update on the CBP. So we have provided the information required by CBP. So pending a decision by CBP. So hopefully we can have the decision soon. And next on the issue of accommodation, which has been the issue in Malaysia, not just particularly on Top Glove, not just on glove industry, but it's a Malaysia issue on terms of providing accommodation to the foreign workers in Malaysia. So over the past 1 year, more efforts has been put in to ensure we are full compliance with the Acta 446 accommodation, which in the past, Act 446 only applied to plantation sector, but it's now applicable to all sectors since 1st September 2020. So with the current action plan, we have identified we have actually sufficient accommodation and will be fully in compliance with the spacing requirement of Acta 446. By this week, we will be in full compliance. So there is some delay in the compliance, mainly due to the MCO 2.0, which has slowed down the moving or shifting of the workers to the new accommodation. Otherwise, we will be in full compliance of the spacing requirement by this week. We also have the midterm requirement plan to ensure that all the workers will be housed at our own accommodation instead of renting from external parties by 2022 and 2023. So the short-term plan is, as shown here, has been adjusted for more people in existing accommodation, and we have purchased previously the hostels and also houses. We also bought some apartments as well recently, 20 million apartment value worth of 101 units of apartments, and also we have rented some other apartments as well to ensure that we have sufficient space. And end of last year, we have moved around 2,000 of our workers relocated to this area called the Westlight PKNS accommodation, which can house in total 6,000 persons, but we have rented 2,000 the places for 2,000 workers for our workers. And in the midterm as well, we have our more hostels to be built, either in Klang or in Bantin, in line with our more bigger expansion in these two locations. And also we have purchased the apartment under construction from a developer, which completion is March 2022. So by then, 2023, end of 2023, sorry, July 2023, we will have make available accommodation for 10,000 people. So with that, we can actually stop all the renting of accommodation outside and move all the workers to our special purpose-built accommodation hostels near to our factories. So going forward, in terms of quarters, we look at coming quarters. We expect next few quarters is still a good quarters for us because of in terms of increase in higher sales volume from new capacity, higher ASP from quarter one. Quarter one ASP is high, but quarter two forward we are looking at higher than quarter one ASP. And also in terms of glove demand continue to be strong, even though the delivery time is shortened, but in terms of the order books is still higher than the normal situation as well. And as mentioned earlier, even with vaccine as well, so glove usage is still required. And with that, Walter, I'll pass it back to you to start the Q&A session. Thanks, Walter.
Hi, thank you, Chong Guan, for your quick and insightful presentation. So I'll move on to Q&A session. So moving ahead, can I just clarify about certain things? I remember we actually posted Top Glove during our Malaysia Corporate Day by CGS-CIMB in January. I remember that your order lead time was much more or even double than the 200 days highlighted in this presentation. Can you actually explain to the attendees of this conference, what is actually transpiring and why have we seen such a steep decline in your delivery lead time?
Thanks, Walter, for the questions. And I think if you look at the delivery time, yes, it's correct. During the period, maybe there's around 500 over days for, let's say, example, nitrile. So currently it's around 200 days. Few reasons. Firstly, in terms of the new capacity, like I mentioned here, additional capacity of 20% from the first quarter. So we have more nitrile capacity. And also in the past, there is more panic buying as well, and also overbooking as well from the customers. So we exclude those customers, so the number of days also reduced. With the number of days reduced, then the sports order also is lesser right now. Sports order is lesser. Last time we have allocated 30% for sports order. Right now, maybe we have around 10% sports order, meaning we still have additional 20% of the capacity which we allocated for sports order. Now we can use it for the contract orders. So these few reasons, then we see that the nitrile number of days has reduced. And compare, of course, with the average of pre-COVID on 30 to 40 days. And of course, we can actually increase the number of days if we are willing to sacrifice the profit, meaning adjust the ASP. The order, definitely the delivery time will actually go even longer. But then these are sort of balancing between the short term in terms of the profit and also some of the long lead time, which ASP will also be adjusted subsequently when delivery time.
Okay, thank you for that, Chung Guan. So moving on to some questions from the attendees of this conversations. There's a question is that, that top glove peers, your other peers in the glove industry are highlighting that they expect ASPs to go up all the way until at least second half of this year. So in Top Glove's view, when do you think the ASPs will start to see a decline? And if I'm not mistaken, Top Glove remains to be a leader in terms of ASPs.
Yeah, I think it's correct. Some of them mentioned about the ASP increase. I think what the situation currently is that there's a gap between the Top Glove ASP and some of the other players as well. So for them is where the point that we can actually make possible. For the month of March, we have been increasing the ASP since May last year. And for the month of March, our ASP we maintain as February for nitrile. For natural rubber, we still increase around 3% in terms of ASP for natural rubber. So April, we have not fixed the pricing yet. So we'll look at in terms of a demand supply situation. So I think for some of the peers, maybe the catching up effect in terms of increasing. For us, we'll look at demand supply. So if we will look at need of more orders, then we may have to adjust the ASP lower so that we are not too far a big gap from our peers as well.
Okay, Chung Guan, I think I'll just take two last questions before we end the session here due to the interest of time. Number one, how is the outlook of the supply and demand dynamics now, given that your order lead time has dropped to 200 days? Do you still expect demand or I'll even say ASPs, to be able to sustain at elevated levels all the way up until at least second half of this year? And also to follow up the second question, can we also provide updates in terms of the CBP issue? When will we likely see a resolution to this matter where we can see the ban on two of Top Glove subsidiaries be lifted? Thank you.
Yeah, on the first questions, Walter, in terms of demand, as shown here as well, 200 days is actually like 6 months of the order in hand. And if you were to willing to lower down some of the pricing, we can even have a longer lead time as well, you see. So for demand until end of the year should not be an issue. I think if you look at the number of cases, it's also not reducing. We may have news on vaccine all that. So that may be, in terms of customers, maybe not so much of panic buying. But if you look at cases in Malaysia or in US or in Europe as well, there is the number of cases doesn't reduce. So I think for demand until end of this year, even for 2022, mid of 2022, not an issue. I think it will continue to be strong. And in terms of CBP issue, as highlighted earlier, so information has been provided. So pending decision by CBP. So hopefully we can hear some good news soon.
Okay, thank you, Chong Guan, for your time today. I'd like to take this opportunity to thank Top Glove and the representative for joining us today here with the collaboration between Bursa Malaysia and CJCIMB for this Shariah conference. Thank you so much, and I look ahead to hosting Top Glove in further events we have. Thank you so much, Chong Guan.
Thanks, Walter. Thank you. Thanks, everyone. Bye-bye.
Okay, Walter, you can, okay.
Okay.
Yep.
Okay. Next on our corporate conversations event we have today, we're going to host Lee Swikat Group Berhad, basically Malaysia's largest natural latex mattress manufacturer in Malaysia. So we are honored today. We have with us Dr. Eric Lee, who is basically the managing director of LSK Group Berhad. On today, I think Dr. Eric will present through his slides, which will then go ahead with a Q&A session. So over to you, Dr. Eric, to share your slides and go ahead your presentation.
Okay, thank you. Good afternoon, everyone. I'll share my slide. Okay, can you see?
Yeah.
Okay, after you all listen to the glove giant, now it's considered a small fly for us. Although we are in a latex business, we are in a latex mattress business. Okay, first we come to company overview. LSK was established since 1975. We are one of the most extensive mattress manufacturers in Southeast Asia. We operate single-branded and multi-branded stores as well as factory outlet stores. We have 2 manufacturing facilities with a total of about 300,000 square feet. Our employees is about 370. Our products, about 50% export and the other 50% is for domestic market. Our vision is to be the largest natural latex manufacturer in ASEAN. Our mission is to be a socially responsible company, helping people to, of course, sleep better and healthier using environmental friendly natural latex and through using energy efficient green technology so that to minimize carbon footprint to the environment. We target to achieve a turnover of 200 million by 2023. We want to build a happy and healthy working culture as well as a strong corporate and consumer identity for the group. This company's overview in terms of our board of directors. We have 3 executive directors and 3 independent non-executive directors. Mr. Lee Swikat is the executive chairman, the founder. Myself, I'm the MD cum CFO. Mr. Winston is my brother. We have 3 independent professional directors. Mr. Richard Wong is the audit committee chairman. He's a chartered accountant and runs his own audit firm. Mr. Lau Tin An is a risk management consultant. He sits in 2 listed companies. And Ms. Xiao is a lawyer. She sits in 3 listed companies. This is our corporate structure. LSK, Lee Swikat Group Berhad is the listco who owns 100% of Lee Swikat Holdings, which is a management company who manage all the operating subsidiaries. LSKS is the family-owned company that controls the listco. We control about 51%. At this moment, we have, LSK have 3 Malaysia Book of Records under our belt. Number 1 is that we are certified as the largest natural latex bedding manufacturer. Number 2, we are certified as the first aniline-free natural latex bedding. What is aniline-free? Some of you may ask. Is something, I make it into a layman term, is something like an egg that we manage to remove the cholesterol in an egg, leaving behind all the nutrients without the cholesterol. Aniline is found in most natural latex and we successfully remove it. Number 3 is that we are the first certified global organic latex manufacturer in Malaysia under the GOLDS. These are some of the awards we won over the years. This is a recognition by minority shareholders watchdog groups. We move on to business overview. These are our brands. Napier is our natural latex bedding brand. Englander is one of the top 10 American brands since 1894. We used to be their licensee for the Southeast Asia countries. And in year 2015, we managed to acquire the trademark rights of this brand for the Southeast Asia countries. So now officially we are the owner, trademark owner of this brand for Southeast Asia, the 10 countries under Southeast Asia. Tempur is the largest viscoelastic mattress company in the world, listed on New York Stock Exchange. We are their exclusive distributor for Malaysia. Visco Bedding is a sub-brand of Englander. At the bottom there is our retail stores, IBG. We have a specialized bedding retail chain stores. MFO is our factory outlet stores we acquired in 2018. Stressless is a small complementary, is a recliner chair from Norway. We are also the exclusive distributor, just complementary sales. It doesn't bring much contribution into our turnover, but it doesn't take up too much space. Meta is a new Italian brand that we are targeting at the mid to low end market. At this moment of business presence, one of our biggest export countries is to US, which made up about 25% of our total sales. And US, now this 25%, they are targeting only the organic latex. Just now I mentioned we are the first and only organic latex bedding manufacturers in Malaysia. And all this organic latex is supplied to US. They are opting for this kind of green products, even from latex mattress, they're opting for these green products for their marketing strategy. The second biggest market is Korea, made up about 15%. Over here in Malaysia, we have more than 15 retail outlets. Together with our consumer fairs, we generate about 35% of revenue under our direct B2C segment. Here I listed down 10 strategic management principles is to show potential investors or our shareholders how the management run the companies. So we wish that we attract the like-minded investors or shareholders. Number one, we remain focused on our core competitive strength, which is embedding. We avoid diversification into non-related business. A lot of people ask us, you're also in latex, why don't you move into glove? But it's never on our mind. Although it's using the same raw material, but the process is totally different. So we are not, it's beyond our circle of competence. Number two, sustainability. We endeavor to ensure sustainability in our business operations using renewable natural latex, as well as green technology in our manufacturing operations. We got green tech license certificates and tax exemption from MIDA for our initiatives. Number three, asset light. We avoid investment in any properties which is not related to our core business. That means we don't invest in any properties just for rental income or whatever. We focus on our core operations so that we want to improve on our return on equity. Number four, building competitive advantage. We focus on brand buildings through intellectual properties, improving our efficiencies through technologies advancement, as well as automation and mechanization to remain competitive in the world market. Conservatively financed. We manage our finance conservatively to be prepared for any unforeseen circumstances. At the moment, I would say that we maintain a war chest. Normally, it's more than what we require in our operations, but this is how we manage our finance so that we can capture any opportunities that arise along the road. Number six, we endeavor to increase our per share earnings. We don't intend to increase the size of the company by issuing more shares without increasing the per share earnings. Number eight, we avoid dilution in shareholdings. We don't issue shares unnecessarily, like through placement to new shareholders, they will dilute the existing shareholders. Number eight, we avoid unnecessary capital raising because actually we ourselves, we also invested in some listed companies. We also don't like the companies keep asking money from shareholders. So we avoid unnecessary capital raising. Number nine, capital allocation. We practice due care in our capital allocation decision so that we make sure that we the money we reinvest in the company can bring in incremental profit. Number 10, reward shareholders. We have a dividend policy of at least 30% on our PAT. Over the past few years, we managed to declare actually more than 30%. 30% is the minimum dividend policy. Next, some financial highlights. This is the past 5 years turnover. The revenue for the group for 2019 increased by 1.6% from 100 million to 101 million. The market condition, the global trade war in 2019 actually has affected some of our export countries, especially the Korea, whereby we have invested in the new production line. We foresee that our sales will increase tremendously to take up the excess capacity, but due to the trade wars, certain of our export countries, their sales got affected, so we have a flat year for 2019. So this is the profit before tax and profit after tax. As you can see, our profit before tax and after tax was on the growth trend until 2018, whereby you can see 2019, there's a dip. This is due to the increase in depreciation due to the new production line that expect to bring in substantially higher sales, which never materialized. So with higher depreciation, we have lower PBT in 2019 as well as PAT. We started paying our dividends since 2016. 2018 and 2019, we maintained our dividends. For 2020, most likely we will maintain the quantum of dividend. This is our financial highlights on our balance sheets. Our shareholders' equity increased from 37 million to about 57 million up to September 2020. Our total borrowings has decreased substantially with a net borrowing of 2.1 million as at 2015 to a net cash of 13.8 million, despite paying more than 10 million of dividend over the years. Our current ratios remain very healthy at average of more than 1.5 times. Our debtors days has been very healthy within 30 days. Our creditors days is about 90 days. Okay, the last line, we talk about unbilled sales. I would say this is actually I'll call it a hidden gem. Why? Because a lot of we get sales order from consumers through our direct B2C segment. So a lot of consumers, they place order with us with deposits up to sometimes 30, 50%, but the delivery will be maybe 2 weeks, 2 months, or even 1 year down the road. So in the meantime, this, we call it unbilled sales, is not recognized as sales in the company's book. But we have already collected at least 30 to 50% cash. So all this, once delivered, the GP of these sales will flow, most of it will flow directly to the bottom line, the PBT, because all the costs involved in terms of rentals, commission, all those things already charged out to the P&L. So this, any future delivery of this unbilled sales, the GP will flow, substantially will flow to the bottom line. This revenue, quarterly revenue for the past 5 quarters, you can see from 4th quarter of 2019, 29 million. 1st quarter of 2020, we start to feel the heat of COVID-19. And 2nd quarter, because our industry is not treated as essential goods during the MCO number 1, so we are not allowed to operate during the period. So our sales was greatly affected during the Q2. But after the economy reopens, we registered a very strong rebound in our sales in Q3. It's one of the best Q3 we have over the past decade, actually since beginning. This is the PBT, quarterly PBT. You can see just from the Q1 of 2020 and Q2. Q1, we start to feel the heat of COVID. Q2, our sales was down by 50% due to total lockdown. We barely break even, I would say. And Q3, you can see we have one of the best Q3 in history because with the high volume, our operations, as I just now explained, most of our costs already charged out. So any substantial increase in the top line, a lot of the GP will flow to the bottom line. So for Q3, we have exceptionally good sales. So that's why we have a very good Q3 PBT. These are some of the share price over the past 4 years. At this moment, our market cap is around 150 million. New growth pillar. This one, okay. We signed a memorandum of agreement with Cuckoo International. Cuckoo International is a Korean-based water filter business company that is one of the fastest rising in Malaysia. Okay, their business is mainly in the rental business, rental model. They rent their water filters by collecting monthly rental fees over a period of 3 to 5 years. They are one of the fastest growing rental business in Malaysia. Within a short span of 6 years, actually, their sales has hit Ringgit Malaysia 1 billion for 2020. So our arrangement with them is that we will supply, we jointly develop a Cuckoo Napier mattress. It's a jointly development between Cuckoo and LSK Napier. It's called Cuckoo Napier mattress. This product will be sold through Cuckoo Malaysia's rental business platform. And this collaboration, we will share the rental receipt in the ratio of 60-40. Cuckoo will take 60%, we will take 40%. This one, initially, the target will be Cuckoo's estimated 1 million current active users. Cuckoo will be spearheading all the marketing and payment activities through their platform, where LSK will be in charge of the manufacturing, supply, and logistics of the mattress products. This is based on the internal target sales volume with Cuckoo International. We estimated that within the next 3 years, there will be at least a volume of 80,000 pieces of Cuckoo Napier mattress to be distributed over this rental business. Year 1 will be about 14,000, year 2, 26,000, year 3, about 40,000. This figure is not plucked from the air. We got market research, market information. In the market, there's another company, also Korean company, doing similar products. Their volume in the first year is already more than 20,000 pieces. And the competitive advantage we have is that we have superior products in terms of the latex quality, latex product, the product qualities, as well as we have the target pricing strategy is that our pricing will be substantially lower, about 30% lower. So the response is expected to be very good. So this sales revenue from this joint venture attributable to LSK over the next 3 years is estimated to be at least about 100 million. From our 40% share, it is estimated to be about 100 million. The GP margin for LSK for this product is estimated to be about around 50%. So with this, our forecast turnover for 2021, we estimated it's about 130, 2022 about 165, and 2023 about 200 million. For this, because the revenue recognition is different from direct sales, because the rental business, the revenue recognition is spread over 3 years, 36 months. So this actually, most of the sales revenue recognition or the profit will be derived in the second or third years. In the first year, let's say the sales registered in the first year, a lot of the revenue or the profit will be recognized in the second and third year. Some investment highlights. We are the largest natural latex manufacturer, latex bedding manufacturers with about 7,000 tons. This is very small compared to glove, but in our industry, we are considered one of the largest. Our product is considered quite inelastic globally because it's a basic consumer necessity, although it's a consumer durable. We have experienced that anything that happened to the demand, short-term demand, that we may experience short-term reduction in demand, but it will rebound back strongly because for those that need to change the mattress, they need to change. They can only delay, so they have to change sooner or later. Number 3, we leverage on demand growth from both local and export markets. Number 4, according to CGS-CIMB, we are considered an undervalued consumer stock with about 11.7 times 21 PE ratio. Number 5, we are in a strong net cash position of 13.8 million as at third quarter of 2020. That's all for my presentation. Thank you. Over to you, Walter.
Okay, thank you, Dato' Lee, for your presentation on the company as well as your growth pillars. So I'll move ahead to the Q&A session. Dato', there's a question on how is the demand for Kuku Nepal mattress at this juncture. Maybe you can clarify to the public on the prospects of this and the future.
Sure. Okay. Actually, the Kuku Nepal mattress, the target official launch will be next month, around mid of March. At this moment, they are opening up only for their internal sales, for their internal sales staff, all those things. And in the first month, we already have pre-sales of more than 1,000, almost close to 1,000 pieces already, just the internal sales. So the response has been very exciting. Yeah.
Okay, Dato', in your business, there's a question whether who is your toughest competitor and what do you think of Geta and the difference between both your businesses?
We don't really talk too much about competitors, but just that in terms of, I would say it based on our test result and our market is that our product quality, through our R&D, internal R&D, our product quality is appear to be superior in terms of, like just now the aniline free is through our own R&D. We also that through our feedback from our overseas customers, okay, we managed to outgrown our competitors within a short span of time. We are, in terms of the latex bedding in Malaysia, we are considered not the most established one. In terms of they are longer than us, more than 20, 30 years, some of them. But we managed to become largest through our product quality as well as branding.
Okay, Dato', thank you for that. Maybe can we also share to the public, you actually see that, you were severely affected by MCO 1.0. Can you actually tell us, how have you seen impact in MCO 2.0 and how has been business so far?
Okay, MCO 1.0 is very bad for us because our factory totally cannot operate. That means it affected even our export operations. MCO 2.0, we can see we are allowed to operate. So our export orders, we still can supply. But over at the domestic front, as you can see from Facebook or even a newspaper, you can see even the shopping malls, all those things, you can see very minimum people shopping around. So definitely will, at this moment, it affected our local sales. As well as like the consumer fairs at this moment is not allowed to operate consumer fairs. So in the short term, it's definitely slightly affected. But because the consumer fairs is not allowed to operate, some of our factory outlet stores, actually we experience higher sales. Because for those that need to buy, they have to find some place to buy. So our standalone store seems like it's performing better than pre-COVID season because people don't go to shopping center because they find that too many people. But our standalone factory outlets, we experience a higher traffic because they find that our standalone store, they feel more comfortable. So we have better sales from our standalone stores. So which more or less made up certain percentage of lost sales through the consumer fairs.
Okay, Dato', thank you for that. So are you confident that FY21 will be a much better year to FY20, assuming that that MCO 2.0 is well lifted post first quarter of this year?
Yes, definitely, yes. 21 will be much better than 2020, yes.
Understand. Dato', can you also share with us, what's the outlook of your export sales for semi-form latex?
The outlook for our export sales at this moment is, I would say, is very stable, and we actually at this moment, we again face some problem in terms of the workforce. Because of the MCO lockdown, some of our workers, they went back since last year for holiday, all those things. Foreign workers, they are not allowed to come back. And our new workers, again, not allowed to come in. So end up, we face some shortage again. It's always a problem in manufacturing industries. So that's why sometimes we may not be able to experience a full opportunity to capture. Sometimes we have certain excess order we cannot accept at this moment. Our workers, we are running on more OTs now. So at this moment, due to that, we may not be able to capture the full opportunities of very strong export orders.
Okay, understand on that. I'll take one last question before we end the session for today. Can you actually give us the breakdown? Have you actually seen a boom in furniture sales because of a jump in US housing data? Has that actually been beneficial for US, given that part you highlighted early in the presentation that some of your sales are to the US?
Yes. So for this, actually, we have, I myself have a conversation with my US customer. I said, actually, during the past 1 year or 9 months, I would say 9 months, why their sales keep remain very strong. Actually, my customer in US also, initially they also puzzled. They say, supposedly, especially you can see US, their cases are tens of thousands, even 100,000 of, it's very, very high. And their sales they don't see a slump in their sales. Probably a few reasons. They told me one thing is that they are mainly on online sales. Their sales mainly through online e-commerce. Secondly, US government has been pumping money into the economy. A lot of people, they can get a few thousands of subsidies. And for those people that got the subsidies, they buy a lot of things. Because some of them stay at home, they buy more furniture, all those things. End up the sales remain very strong. So they don't really see a slump in terms of the demand.
Okay, thank you, Dato' Eric, for joining us today. We appreciate your time that you spent with us today. I also like to take this opportunity to wrap up the Shariah conference we had today in collaboration with Bursa Malaysia and CGS CIMB. I'd like to thank all participants who have joined us throughout the whole afternoon. Thank you so much. And again, to Dato' Eric, thank you for joining us.
Thank you.
We look ahead to hosting you guys more in the near future. Thank you very much.